Mentioned then in the headlines, down by around 0.3% on the back of that retail sales number. We'll wait for the gilt market to open and we'll see what happens to yields there and what happens to assumptions around the BOE. Brent then heading for a fourth week of losses on oil prices. 77 the handle now on Brent. It's up a little this morning, but that after fears around stockpiles in the United States sent it lower in yesterday's session. And here's iron ore. Put this in just because that's continuing the negative theme around commodity prices that stood out so clearly on the GMM screen a little earlier on. Tom, what do you see on futures?
Futures in positive territory. FTSE 100 futures looking to add 26 points. Over in Germany, the DAX is pointing up by 0.2%. In France, the CAC is looking to add 21 points, up 0.3%. We focus on technology, we focus on energy.
Okay, so that's the futures picture. We should point out, of course, that European stocks were pretty weak yesterday, and so part of the reason we might see some strength today is that rebound. We certainly underperformed some of the other major markets in yesterday's session. We were talking about some of the earnings disappointment of yesterday. So here's a bit of a rebound, just kicking off. The FTSE 100 up just 0.1% this morning. We'll wait for some of those other listed markets to open up this morning then. The pound, this is the reaction to the retail sales data. It's down by around 0.25% as we wait to see what happens. There we are at the front end of the gilt curve. We see yields coming down by 4 basis points or so on the 2-year gilts, as the market has increasingly been talking about rate cuts this week. We got some pushback on that narrative, actually, from a couple of Bank of England voices. More on that in a moment. But now we've got the retail sales data also looking pretty negative, coming in below expectations on the month-on-month and the year-on-year figure. We'll see where that leaves the Bank of England conversation. And here's what was a very negative picture on commodities, looking a little bit more mixed right now. Here's the equity markets then, Tom, looking positive, up by around 0.5% on the French market as European stocks try to bounce back from some of the weakness of yesterday. What do you see on sectors?
Well, gilts, of course, important as well when we think about the financial services sectors and the bank sector here in the UK. And banks as a sector gaining 0.4% as well on the back again of that weaker retail sales data out of the UK and expectations that the Bank of England may bring forward any cuts for next year. Financial services currently gaining 0.3%. One sector that stands out in terms of being on the downside, the red coming through for technology. Not a big surprise. We knew that because of the reporting into this potential investigation by the Department of Justice in the US into one of the biggest suppliers of tech equipment there, that maybe there'd be a read across, and you're seeing that. So we focus on companies like ASML. That sector currently down 0.3%. And again, the investigation into the supply of equipment to China. Basic resources gaining 0.8%. Energy up 0.6. Anna put it in context for us. The sell-off yesterday, of course, and it was energy, the leading loss maker across your sectors yesterday. So pairing some of those losses, again, though, you're set for a 4th straight week of declines for oil prices. But as a sector today, given the sell-off we saw yesterday, not a big surprise. You're seeing a little bit of upside, 0.6%. That's broadly the picture across these sectors then. Still green on the screen. One sector in the red for us, technology. Across your benchmark, gains of 0.4%, 453 on the European Stock 600 benchmark.
Okay, US futures looking almost entirely flat, so we'll see how long this lasts. Sam Unstead joins us from the Markets Today blog to take us through some of the stories they're covering, and we will stick to some UK themes then in this conversation, Sam, and start with the UK retail sales story. So we saw a drop in gilt yields then in response to the retail sales data. Give us your take on what we've heard on the UK.
It was pretty weak, you know, the retail sales data today, and I think that there are a couple of takeaways from it. One is that this divergence between volumes and the value of sales is continuing. The actual total number of sales being made, volumes, is lower than it was pre-pandemic, whereas the price has gone up about 17%. So that's quite a significant divergence there. The other thing to note about this, and we note this with every retail sales report in this country, is the weather. But it was quite a strange month for weather in October. And we have some retailers saying that their sales suffered because it was too wet, and some retailers saying they suffered because it was unseasonably warm.
Right. I mean, I don't know what normal looks like now, if that was all strange.
What, in terms of weather?
Yes.
I mean, I love that we're a cliche here in the UK, talking
Happy to
about
play
the
up
weather.
to it.
Yeah, no, we'll play into that. We'll lean into that. Thanks, Sam. Do the BOE care about the weather? I mean, does this...
They do.
On a serious note, yeah, they do. They clearly must do. It has to be a factor for them as well. Do you think, as we're looking, I'm looking at the work function now on the terminal, you're looking, 525 was what the rate is currently now, the benchmark in terms of the Bank of England. The market's suggesting you get down to, 5% by May of next year. How are you thinking about the BOE reaction to this?
Yeah, it's a 60% chance at the moment of the first cuts coming in May. That's kind of consolidated over the course of this week as we've had this kind of flood of data. We've had multiple officials kind of pushing back on that, and I think that now is going to become your narrative for quite a long time, is that the Bank of England will be pushing back, saying, look, we need to keep things restrictive for an extended period of time.
Given the wage data, for example.
Exactly.
We saw that earlier this week.
And I think markets themselves have decided that extended period of time is almost certainly going to be somewhere in the middle of next year.
Yeah, define extended. Well, we'll be down to that conversation, won't we? The plateau on Table Mountain again. Let's talk about takeovers and what's going on in the London market. Tom was covering in his morning must-read earlier on the piece by our colleague Merrin Somerset-Webb talking about how, I mean, in her view anyway, UK stocks are really, really cheap, and she sets out lots of arguments, but clearly making the point that there's plenty of foreign buyers and private equity money that sees value in the UK, and we're seeing some of that.
Yeah, and particularly in the small cap space. So we've seen a host of takeovers over the last couple of months. The one we had yesterday, which I think set the newsroom chatting, was Hotel Chocolat being taken over by Mars at a 170% premium. I still think that premium seems incredibly high, but you can see there is kind of a dislocation at the moment between the valuation of these UK companies and the value that potential buyers see in them. And so you're seeing this continue, but particularly in the small cap space where the valuations are very, very low.
I know it's a different theme, but I think it's really interesting. When we talked about, if times get tough, we talk about the lipstick effect and people trade down to affordable luxuries. And the same can be said about kind of luxury chocolate, can't it? Because you might think, if times are tough, do people really spend a lot of money on chocolate? Don't they trade down? But they might be trading down from something else more expensive. So
yeah, very possible. Yeah. I mean, I think some of the takeovers you see are these kind of value dislocations, right? Where foreign buyers in particular see there is genuine value in these stocks, but the UK market, particularly the small cap market, the liquidity there isn't strong enough to push those valuations higher. And so, this is why we have this consistent debate about how to boost UK markets.
I do not see Anna Edwards trading down from her green and blacks to Cadbury Fruit and Nut. I don't see that.
Plenty of brands are available, and most of them are in my cupboard.
Sam, thank you very much indeed from our Markets Today blog. You can get more, of course, from the wonderful team, including Sam, on the front page of the Bloomberg UK website. Have a look, or type TLIVGO on the terminal. OK,
here's what we're looking out for today. We've already had the retail sales picture out of the UK, but plenty more to come. 10 a.m. UK time, we get the final CPI reading out of the euro area. Then US housing starts, that data coming in at 1:30 p.m. at UK time. Finally, in the afternoon, we'll hear from a slew of central bank speakers from the European Banking Congress. So as we mentioned earlier, we've had the retail sales story in the UK set to dominate. We get the Eurozone inflation data. We spoke to Mario Centeno, didn't we, just earlier on this week, and he was a little tight-lipped about whether it would be April, whether we'll get cuts as soon as that. But we've got softer and softer inflation data coming out from many geographies now, and so it seems, in good company, when will we get to the first of those rate cuts is going to be increasingly the question we're asking.
Yeah, and to what extent and when does the UK close the gap? When you look at 2.9% for the Eurozone, we'll see how that changes with the data out today, with the UK on a much higher handle, of course, in terms of the inflation coming through here. When does that gap close, or is the UK positioned for higher for longer inflation, any more extreme and more significant effect than maybe some other jurisdictions? So we look for those voices as well in the data coming through from the Eurozone. The other thing we're looking out for, and this is coming up, stocks on the move, of course, including European chip makers, really significant reporting around what is happening with Applied Materials facing a US criminal probe into potential shipments to China. The implications for the broader space, particularly here in Europe, we'll unpack that story for you. This is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg. This is Markets Today. We are 10 minutes into our European trading session, showing some positivity across these European markets. US futures look fairly flat, perhaps improving just around the margin, but fairly flat, actually, this hour. Let's check in on some of the individual stocks on the move. Joe Easton from our equities team has a briefing for us. Joe.
So London Stock Exchange shares coming down slightly as expected. They did do a £1 billion buyback after the close of trading yesterday, but analysts disappointed that they haven't raised their sales guidance, and that is weighing on the stock. That capital return not enough to boost that one this morning. Aston Martin driving higher on that one, up around 6%. As we said in stocks to watch, the company in terms of the Formula One business has sold a stake to private equity, and that is seen as a potential boost for their marketing, given the whole F1 theme that they're trying to play out there. One stock getting absolutely slammed is Volvo Cars. Now, this has a bit of a link to Aston Martin. Geely is selling a stake in Volvo Cars. Geely over in China also owns some of Aston Martin. They're selling shares at a discount. It's a bit of a technical thing because there's worries about them having too much of a stake and that not making the stock liquid enough. We can see it dropping around 11%, skidding off the tracks if we're looking for a pun on that one. Interpump, meanwhile, now this, not as glamorous as flashy cars. This is stuff like hospital trolleys, safes that go into hotel rooms, that kind of thing. Selling shares at a discount. Now that one is pricing at around 38. Some of the indicated prices I saw trading at 42 yesterday. Big discount. We're seeing a little bit of a slip in that one at the moment. Then we're going to flip over a couple of the big sectors in focus. Firstly, we've got a couple of broker moves here to note. Fresenius Medical, they get an upgrade. Now, that one has been slammed following worries about potentially obesity drugs reducing the demand for some dialysis machines. SocGen goes buy on that one today, lifting the stock around 4%. Vestas, meanwhile, upgraded at JP Morgan. They come up to neutral after 3 years, recommending people sell the Windmaker. And a couple of retailers here, H&M and Inditex, the owner of Zara, getting a boost after Gap rose 17% in the US following strong sales numbers, and that is feeding through a bit of positivity, making up for that weak UK retail sales data. Then finally, we'll have a quick look at some of those chip machinery stocks that are in focus. We're seeing a bit of negativity in ASML and also Soitec. Soitec over in France is actually one of the suppliers to some of the South Korean companies in that Reuters report about a potential breach of US sanctions. We'll have to wait for any more commentary around them. The other ones were indicated low, but coming up slightly, seeing a little bit of a read across, as I say, mostly in ASML, not too big of an impact, but chips in focus again.
Joe Easton from our equity team on everything from luxury cars to hospital trolleys. Thank you very much indeed. Let's get back to the oil story and how this ties in to equities going forward. WTI crude headed for a fourth weekly loss, as we've been discussing, after sinking into a bear market. Crude's run of 4 straight weekly declines, the longest losing streak since May. It's come despite collective, of course, and voluntary supply cuts by OPEC and its allies. Let's bring in Janet Muirner, Head of Market Analysis at RBC Brewin Dolphin. Janet, I wonder for your views on the energy markets. We've had a lot of guests coming in and onto the show talking about the value that can be found in European oil majors. Does this put that analysis to question? Can you have a falling oil price and still see value in Europe's oil majors?
Hi, good morning, Tom. Thanks for having me. I do think so. I think that there's value in oil majors. I think you don't actually need the oil price to rally strongly in order for these oil majors to deliver, actually, because I think they have improved capital discipline and they're returning shareholders to capital, and they are also shifting more to renewables. So I think, this is actually a good potential buying opportunity, because we always have this oil price volatility, particularly as we transition to a net zero strategy. So I think it is a good hedge against higher oil price and volatility, as well as higher inflation potentially. We do think that inflation may be still structurally higher. So I think it is a good hedge, and the sector is still cheap relative to the broad index.
Janet, can I ask you about UK stocks? That links in with oil, of course, but going to slightly smaller market capitalisation. UK small and mid caps are irrationally unloved, says Bloomberg economist Marion Somerset Webb. What do you make of UK stocks around the small and the mid cap size? Are they unloved? Do you see value there?
Yeah, they're certainly unloved. And there is value there, but there's a reason why they're unloved. If you look back at history, actually, UK small and mid cap, they have great outperformance over the larger cap. And I think the story may repeat itself in the very long term. I think this could be a good buying opportunity. But I think in the very near term, investors will still remain cautious on the UK. First of all, is the economic outlook. We see more of that weakness coming through in today's retail sales data, consistent with our view that the UK economy is actually vulnerable to high interest rates. And I think, it is not like the large cap, which has more international exposure, and that could benefit from the weaker sterling, for instance. And we have, election uncertainty coming up next year. So I think UK investors may still be a bit more cautious. But I think, long term, that there is value emerging from these small and mid-cap stocks.
Okay, so there's caution around the UK space. I wonder, it sounds like it's too soon then, in your view, to position for cuts coming through from the Bank of England. How are you thinking about the prospects of interest rate cuts from this Bank of England on a weaker UK economy, and how you might position your portfolio for that?
So I think the recent movement in the economic data is actually consistent with our view and strategy so far. We have been overweight gilts, and we actually bought more gilts in early October, because primarily it is the thesis that the UK economy is just more vulnerable in terms of high interest rates. There's high interest rate sensitivity, especially compared to the US. So we still believe in that strategy. However, I don't think we're adding more gilts at this stage, primarily because gilt yields have fallen very sharply already. And I think you need more patience for that strategy to gain the rewards. We do think that the Bank of England, it won't hike interest rates anymore, but they're still guiding that they won't cut. I do think that when the economy does slow and inflation does move closer to that 2 or 3 handle, they will eventually start to cut maybe in the second half of next year.
Okay, so cuts in the second half. When you talk about higher interest rates, vulnerability, I assume you mean in the mortgage market, Janet. Is that the case? And then also tell us your thoughts on the US and how tough things get there in the kind of hard and soft landing conversation.
Yeah, so I think we have more conviction on the weakness in the UK economy, and that's why we have an overweight in UK gilts. I think it is exactly as you say, the mortgage market is the 2 to 5 years fix versus the US 30-year fix in general. So I think the US market, to be fair, we think it's a 50-50 chance of a soft landing and a hard landing. I think it's because, well, the yield curve was very inverted. I think that is usually a good sign of a recession, and we have such elevated interest rate which will last for quite some time. So we can't disregard that. But then actually the data has been moving in a soft landing kind of scenario, slower inflation, slower growth, but still okay-ish. Although I have to say the labor market data is pretty much lagging. The unemployment rate has risen by about 0.5 percentage point from the trough of 3.4%, right now 3.9. And historically, recessions tend to happen when you have the unemployment rate rising more than 0.5 percentage point. So I think we are still erring on the cautious side.
Okay, still caution coming through from Janet Murray and the team, Head of Market Analysis at RBC Brewin Dolphin. Thank you. Coming up, Alibaba scraps a plan to spin off and list its $11 billion cloud business. It was a surprise. We're going to dig into the results and why they came to that decision around a U-turn on the restructuring. That is next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Was going to keep World Cup. This is a 3 as the economic picture, covering the intersections of Hollywood, Silicon Valley, and
beyond. This, at first glance, is just a smartphone. But once you know what's inside, it becomes clear it's so much more than that.
So what really changed everybody's view of this device was what was at the heart of it, the microprocessor that was designed and manufactured in China.
It's at the center of tensions between the world's 2 biggest economies. The phone made by Chinese tech giant Huawei represents a breakthrough by Beijing as it tries to escape Washington's controls on its access to technology and establish a self-sufficient chip industry. If those U.S. controls had been successful, Then a smartphone as advanced as this simply should not be possible without importing key components.
China now is more capable than ever of building advanced technologies.
And it worried U.S. officials who are more concerned about advanced chips going into military equipment than smartphones. It left them wondering, how exactly did China do it?
That's Bloomberg's mini-documentary, When Huawei Shocked America with a Smartphone. You can watch the full version on your Bloomberg terminal or on Bloomberg.com or on our social media platforms. Now, staying with the US-China tech tensions, $20 billion has been wiped off the market value of Alibaba. This comes after the e-commerce giant scrapped plans to list its $11 billion cloud business. For more, we're joined by Robert Lee from our Bloomberg intelligence team, who can give us analysis. Robert, so has the decision to pull the cloud IPO, did it come as a surprise? It's been sort of weighing on sentiment.
No, absolutely. With the stock price down around 10% today, it did come as a surprise to the market. But having said that, I think there were some warning signs there. So as your viewers may appreciate, Alibaba Cloud appointed Daniel Zhang as its new CEO in June, and then he departed within 3 months. So that itself, I think, was a initial sign that something was up within the business.
We had a note drop from HSBC, Robert, I just want to reflect on HSBC's note, their reaction to this. So it dropped in the last few minutes. They say they maintain their buy rating on Alibaba. They say the valuation remains attractive. The dividend might put a floor under the stock, but they do see a lack of catalysts to re-rate in the near term. What are you going to be focused on as you think about how this company evolves over the next few months and quarters?
Okay, well, I mean, the reason behind the original breakup of the company was, this is fundamentally a conglomerate, and the logic being that the sum of the parts is greater than the whole, and therefore, if businesses like Alibaba Cloud could IPO, attract a decent valuation, that would realize value for shareholders. And you must appreciate, Alibaba's stock performance has been far from the best in the sector. The stock price is down something like a third from its peak in January. So there's been a lot of pressure coming up from shareholders to realize value and deliver a better return. So I think strategically going forward, Alibaba needs to focus on the profitability within its key units, including its cloud, refocus on the profitability of those, and ultimately, if they can return it to the growth curve, it's a possibility that they could go back to the original plan and look to IPO this again at a later date, but that is unlikely to happen anytime soon.
Okay, Robert, thanks very much. Robert Lee from Bloomberg Intelligence. Let's quickly check on one of the big movers of the morning. Volvo Cars, really in focus. The Chinese billionaire that owns Geely is raising around $350 million by selling part of its stake in Volvo Cars. This is actually in response to investor concerns about a lack of free float. So that's interesting. You might think that in some senses there might be also reasons to send the share higher, but this is certainly putting pressure in a downward direction right now on Volvo Cars. So maybe that more free float is a story for another day. So that's the story around Volvo Cars. More on Spanish politics coming up. Spain's Prime Minister Pedro Sanchez wins re-election, but the socialist leader starts his new term facing a strong backlash. We'll discuss relationships with the nationalists and separatist parties in Spain. That's next. This is Bloomberg.
Connection lost.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Let's get to your top stories. Surprise reset. Alibaba slumps after scrapping a plan to spin off and list its $11 billion cloud unit. Oil heads for a fourth weekly loss after entering a bear market, weighed by concerns over a supply glut. Plus, sterling slips as UK retail sales post a surprise drop in October. September's figures get revised lower in another sign of weakness in the UK economy. So, Tom, the focus really on the macro when it comes to the UK, the retail sales numbers looking weak, again giving us a reason to think about when we get cuts from the Bank of England. In terms of global stocks, we're actually seeing some strength in Europe.
We are. We're seeing some optimism coming through across the European benchmark now. 0.7%. It's nothing to be sneered at in terms of the gains coming through. We did see some losses, of course, yesterday, so making up for the downside that came through from European equities yesterday. And yes, the macroeconomic data, the data here in the UK, the bad news is good news narrative coming through when it comes to, for example, the real estate companies here, the financial services companies here, as well as gilt yields move lower again in the session, just above 4% on the 10-year here in the UK as the benchmark. So that's the move across the European stock 600, 0.7% here in the FTSE 100 here in the UK, adding 47 points. The DAX over in Germany, 15,870, up 83 points, 0.5%. Let's flip the board then and see how things break down on a sector-by-sector basis. One of the biggest losers, in fact, the biggest losers across the individual stock space, Volvo, on the back of that stake sale, Volvo Cars by Geely's Li Shufu, so that is weighing on Volvo Cars. Autos, though, as a sector, is managing to hold on to gains of 0.4%. The travel and leisure doing very well. Flutter here in the UK, one of the leading gainers in the session today. Travel and leisure as a sector up 1.2%. Energy, despite the fact we're getting to a fourth straight week of losses in terms of additional supplies coming through from oil and Brent and pressure on prices there, energy is actually gaining 0.5%. Very heavy selling across that sector yesterday, so pairing some of that loss. Financial services again, and banks gaining on the back of lower gilt yields today, up 0.9% in financial services. Banks orders gaining 0.6. Across your sectors then, pretty decent gains so far this Friday. Basic resources up 1%, and even tech as a sector up 0.4. A turnaround there, because there have been concern there'd be a read across in terms of this probe by the DOJ and so on, the biggest suppliers of chip equipment to China. But so far that sector is still holding on to gains as well, 0.4%, Anna.
Okay, let's move on to matters political and talk about Spanish politics. Spain's Prime Minister Pedro Sánchez has finally won re-election after a confidence vote yesterday. The decision ends months of uncertainty after an inconclusive election back in July. Joining us now, Caroline Gray, lecturer in politics and international relations at Aston University. Caroline, very nice to have you with us. So months of uncertainty is right. The election took place in July. It's taken this long to form a government, basically, and Sánchez had to do a deal with Catalan separatists to make this happen. How stable do we think this new government will be, Caroline?
Well, very much like the previous term, in order to govern, Sánchez needs the support both of the radical left party at Spain-wide level, but also of several regionally based parties, 6 in total, which includes this time your strongest Catalan separatist party. So previously he needed the same array of parties, but didn't actually need the strongest separatist party, whereas this time round he does. So it's an even harder ask in that sense to govern, and it's why we've seen more concessions needed in the form of an amnesty for those who were involved in organising the attempted Catalan referendum back in 2017.
And the right-wing parties are very angry about this, clearly, and we've been hearing from them. In terms of the policy agenda, what this means for Sánchez, then, he was pretty successful in passing, almost 200 pieces of legislation in his most recent term. Presumably that becomes more challenging in terms of enacting policy. What is the likelihood that Sánchez can actually get things done?
Well, if we think about it, back at the start of the previous term in 2019, actually political commentators were predicting that Sanchez wouldn't last because he had he was dependent on such an array of parties. It was such a polarized parliament. But he did last, and as you've pointed out, he did actually enact more measures than were expected, and 3 budgets were implemented. Obviously, this time around, it's not so easy to kick the can down the road with territorial tensions, with finding a new territorial model for Spain. So, obviously, that makes things harder. But similarly, at the same time, it's not like we've got a united opposition. We do have the Conservatives, we have the far right, but they don't have really a lot of clout in the sense that they already tried to form a government. Voters know that there's not a clear alternative. So I think, Sanchez did better than expected in his last term. He survived longer, and he may well do so this time, defying expectations.
Caroline, the deal he's done with the separatists, does this push territorial matters higher up the agenda in Spain? And what do the separatists get from this deal?
Yes, definitely. I mean, basically, there's a law being proposed, which is an amnesty for all those who were involved in organising the 2017 Catalan referendum, which was illegal, was against the Spanish constitution. And a lot of those have already been punished. But the key figure, Carles Puigdemont, who led the referendum, was Catalan regional president at the time. He has been in self-imposed exile, essentially, not returning to Spain because he would face charges. So basically what this amnesty means, if the law is passed and approved, is that he would be able to return, and all those involved would be freed of any convictions, or those who have charges against them who haven't yet been convicted. But obviously what Spain needs is a form of new territorial model. You've got not only your Catalan nationalists, but your Basque nationalists as well, who are calling for a revision of Spain's territorial model to recognise the presence of different nations. At the moment, Spain is the only recognised nation. And all of this now is really at the fore, because those regionally based parties can withdraw their support from the Spanish government at any time, and the Spanish government can't govern without them.
Caroline, when it comes to the economy, there has been a focus from this government, from Sanchez and his team, to enact more policies around the workforce, shortening labour hours, or at least working hours, more benefits for those, for example, on maternity leave, other measures to support the workers of Spain. Are those measures, is he able to make more progress on those measures? And does that put Spain at loggerheads with Brussels in any way, in terms of the fiscal space that they have for that kind of largesse?
Yes, well, I mean, bear in mind that the socialists are in coalition with the radical left in Spain, Sumar, and then most of the regionally based parties that are supporting them are also quite left in origin, or at least centrist, and so would support a number of these measures that he's proposing, such as reducing the number of working hours in the week to 37.5, such as increasing the minimum wage to make sure that it's at least 60% of your average wage. So all these proposals are inevitably, left-wing proposals designed to help during a cost of living crisis. I think it is very likely he will be able to pass these because he does have the support from those supporting his government, or at least for most of the measures, not necessarily for all. But then, in turn, there could be some concern from Brussels about what this might mean for investors' confidence in Spain. New taxes are being proposed on banks, on energy companies, on large fortunes. So this may have an impact on investors' confidence in Spain, and obviously then risk a rise in Spain's risk premium. But it's quite difficult to say at this stage until we see exactly which measures they push forward with, because quite an array have been proposed.
Really great analysis. Caroline Gray, thank you so much. Lecturer in politics and international relations at Aston University, on Spain and the firming up, at least, of the new Prime Minister Sanchez after quite some time. Coming up with Luxury Slump, will the luxury slump continue into the holiday season? So we switch focus to the luxury sector. We're going to get the view from Sweta Ramachandran, fund manager at Artemis Investment Management, after the challenges, for example, at Burberry. But we'll zoom out and take a closer look at the broader space. That is next. This is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back. This is Markets Today. 41 minutes into a European equity session that's actually pretty strong, up by 0.7% on European stocks. And we are seeing US futures recover a little as we've gone through the last hour or so. NASDAQ futures just into positive territory. E-minis up by 0.2%. Let's think about the gilt market, the bond market, and sovereign debt in the UK, because here we're seeing some interesting moves as a result of the retail sales, weakness in the retail sales data, following on from a sluggish inflation picture, lower than expected earlier on in the week. We'll put aside the strong wages story for the moment, but most of that data suggesting, well, asking questions about how soon we see cuts from the Bank of England, and as a result, the gilt market moving on that, and we see yields coming down. The pound has slumped as a result of that story. The pound is at 123.94. Let's talk about a big UK corporate that could care very much about interest rates and FX. Burberry shares are struggling for direction this morning. That's just a day on from when we saw them plunge, when the British luxury fashion retailer warned that this year's revenue targets may be out of reach amid a global slowdown in luxury spending. So with the holiday season just around the corner, how will the sector hold up during this all-important period? Let's bring in Sweta Rabachandran, fund manager at Artemis Investment Management, for analysis. Sweta, good to speak to you. So let's start with the Burberry story, shall we? Because we've heard from a lot of luxury names now this reporting season, so good to put it all together with you. Burberry and the weakness at Burberry, is it a Burberry story, or is this something that tells us more about the sector?
So there's no doubt that the sector is in the middle of a slowdown following 2 years of really supercharged growth. To just set this in context, the luxury sector has typically grown by about 7 to 9% revenue CAGR over the last 25 years. But in the last 2 years, we've seen growth of about 20 to 25% a year. And that was the expectation was that was clearly going to slow down with this revenge spending at the end of the pandemic winding down. But different companies have really seen that to a different extent. So that deceleration is happening much more differently based on where you are, how exposed you are to aspirational versus high-end customers. For example, Hermes Q3 sales of plus 16% versus Ferragamo, on the other hand, of minus 14%, really kind of paint a picture of how bifurcated and dispersed the growth in the sector is at the moment.
This is the big luxury shakeout, isn't it? So the winners and losers are becoming clearer as we shift into this new kind of growth dynamic post-pandemic. What are you seeing in terms of, and how do you think about the term around defensive luxury then? If we're concerned about growth, we're concerned about the impact of higher rates, we're concerned about the consumer, even at the high end, where are you finding defensiveness within the luxury space?
I think it's no surprise that the most expensively valued companies in the sector also provide the most defensiveness in terms of earnings growth. If we look at Ferrari or at Hermes, these are sort of among the more expensively valued names in the sector, but they also have a uniqueness about their revenue model, which is based on wait lists and supply discipline that also insulate them somewhat from the wider slowdown that's underway. And the other thing to remember it is a slowdown, not a meltdown, in the sense that we're going from the days of 20 to 25% growth back to trend, which is about 6 to 7% growth. But what investors are focused on at the moment is how bumpy that ride back to trend is going to be. And for some companies which are executing a turnaround at the moment, it's possibly that it's likely to be bumpier than for those that have been consistent with their strategy over the last 2 years.
And Sweta, interlock this analysis with what's going on in China, if you could, because we've talked about the sort of the aspirational consumer versus the high-end consumer. How does the Chinese story play into that?
Yeah, so that's a really good point in that China used to obviously drive about a third of the sector's revenues before the pandemic. And with the slump in Chinese overseas travel, Chinese consumers' contribution overall to the luxury sector has also meaningfully declined as a result, even with the dramatic pickup in the local market. What we're seeing now is a slow return to overseas tourism. There's been backlog in terms of flight capacity, as well as visa issuance that's kept that pace a little bit slower than may have been expected. But that is happening. And actually, for the holiday quarter, which you were talking about earlier, China probably provides some support in that Q4 of last year. We're lapping pretty much the easiest comps in China because of the exit from lockdown this time last year, which led to basically mass infection across the country from the Omicron variant. People were not really shopping for luxury at that time, which means the comparisons into this year are much easier. However, the question is to what degree that will be offset by a growing weakness among the US and European consumer.
Well, on the US consumer, Sweta, as we look out to 2024, how do you expect the US consumer to adjust in this environment where we are actually now seeing, starting to see softness, real softness in the US jobs market, and of course pricing coming down broadly in terms of inflation? How is the US consumer expected to adjust when it comes to luxury into 2024?
I mean, the luxury consumer in the US is somewhat different from the consumer who is experiencing the most severe cost of living pressures. And so in that sense, I would say that we need to look at the fact that the US consumer has actually doubled for many luxury companies since the pandemic as a percentage of revenues, with many new consumers entering the market. Now, this year, we're seeing that go back a little bit because obviously the unwinding of the effect of stimulus checks and excess savings has had an impact on the luxury sector, but we haven't gone all the way back to pre-pandemic levels. So many of the consumers recruited during the pandemic have stayed with the sector. And it's possible that the US market, which has actually been slowing down for some 5 or 6 quarters for the luxury industry right now after having peaked in mid-2022, is positioned not to deteriorate further. And some indications are that actually that is happening for some companies, but not all. And again, here, we really need to pay attention to aspirational consumers versus high-end consumers, because in the US in particular, aspirational consumers seem to be the most hard hit. And the brands that have spoken predominantly to this consumer are also consequently seeing the worst of the slowdown from this market.
Really interesting. Always the smartest takes on luxury. Sweta Ramachandran, fund manager at Artemis Investment Management. Thank you for joining us this Friday with the context and the analysis on the luxury space. Let's get some of the other top red stories on the Bloomberg terminal today then. International pressure on Israel is growing, with the US and its European allies pushing a peacekeeping plan. This after Prime Minister Benjamin Netanyahu said Israeli forces have found a Hamas command center under the Shifa hospital in Gaza City. The average tax collected per UK bank employee jumped by more than 11% in 2022 compared to the previous year. The new data comes from a survey of the sector by the trade association UK Finance. On average, the government now collects more than £42,000 a year in tax per bank employee, with increases largely due to government freezing income tax thresholds and a temporary increase in national insurance.
What about the fiscal drag? Now, Bloomberg understands that Apple has fallen further behind in its multi-billion-dollar effort to make a modem chip for the iPhone. The company will likely miss its 2025 goal to roll out its own cellular modem as it struggles with the complex process of replacing the current Qualcomm technology. Sticking with technology, Applied Materials fell in late trading after a report that it's facing a US criminal investigation for allegedly violating export restrictions. Reuters says the firm, the largest US maker of chip-making machinery, is under review by the US DOJ for allegedly sending equipment to the Chinese chipmaker SMIC. The US government restricted sales to SMIC back in 2020 on alleged links to China's military. Applied Materials says it remains committed to compliance with global laws.
Coming up, motoring ahead. Formula One's gamble on Las Vegas hits a bump in the road. We'll look at what's going wrong with the motorsport's first race in Sin City in 40 years. That is next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today, 8:52 here in London. European equity markets trade higher this morning, up 0.7% across these European equity markets. US futures also slightly more positive than they were around an hour ago. Let's get to another theme, though. The first Formula One Grand Prix in Las Vegas in 4 decades was supposed to be the latest big sports win for Sin City. Liberty Media, which owns F1, of course, has poured hundreds of millions of dollars into building the street track and the infrastructure around the city's famous strip. But hotel room rates and ticket prices have been tumbling leading up to this weekend's race, with organisers struggling to sell the last remaining seats. In an interview with Bloomberg, Liberty Media's CEO remained upbeat about the event.
I think each of the races has a different character, and they're very, have characteristics which make them unique and special and all worthy. I do think Vegas is going to be unique in that it's a night race down the strip on a Saturday night. I think it's going to be iconic. The visuals will be amazing. And I am not worried about demand because we have been lucky enough to see interest in Formula One explode here in the U.S.
Joining us with the latest on the story, our colleague Danny Berger. Danny, good morning to you. So they all have their own individual style, these races.
Yeah.
So let's talk about the Las Vegas style.
It's got quite a bit of style.
Yeah. So this was supposed to be, I mean, they do sell out. Usually these events sell out. But something's gone wrong in Vegas. What's gone wrong in Vegas?
Well, I think the current race leader, and will be the race leader for this year, Max Verstappen, put it well when he said Vegas is 99% show, 1% racing. You know, when you go to
Vegas in a nutshell.
Yes, no, that is Vegas. You expect to lose all of your money and be awed by glitz and glamour. So unsurprising that this thing is really expensive and has a lot of glitz and glamour that usually F1 doesn't have. But Liberty Media maybe overestimated the degree that F1 fans actually want that. You see that in the hotel prices that are tumbling. Ticket prices had been cut in half before the event. And this is especially bad for Liberty Media because in a rare step, they've actually paid for a lot of the operation and the promotion. Usually a third party will do that, but they spent $500 million buying, I don't know, 40 acres of Vegas land, which is kind of a strange move. Even for, I mean, the race is essentially happening now because it's nighttime in Vegas, but they've had to pause it all because a manhole cover came off and damaged Carlos Sainz's car. Again, I'm not an expert, but you think you'd want the manhole covers to stay on the road for
would. That sounds like the kind of issue we have in residential Barnet, not in Las Vegas.
And so presumably you're not driving a McLaren F1 car over.
So they gambled on this. They may lose all their money. What about the bigger gamble on the US market? Are we seeing cracks there?
Well, interest in the U.S. and viewership, for example, of the Netflix show are slightly down, but overall U.S. viewership is up, again, thanks to the Netflix program. But you have other F1 venues in the U.S. You have Miami, you have Austin. Both of those have been success. But Austin, for example, it's a very different race. It's more affordable, more accessible. And in this economy, maybe people don't want to splash out on tickets. The other thing, Tom, your good friend Christian Horner over at Red Bull, he's just running away with the thing with his driver Max Verstappen. So someone like me, an American Mercedes fan, is maybe a little less entertained because you don't have that competition.
Are you showing your colours?
I admit my biases.
Danny, thanks very much. Bloomberg's Danny Berger with the latest there. We need to check, this is theme related, we need to check some share prices for you. Let's say with the auto sector, I've got the Volvo share price, which you can see is under pressure today, down by 10% as a result of Geely basically raising around $350 million, selling part of its stake in Volvo Cars. It's designed to improve the free float, but we'll see what happens next.
Big move that I'm focused on, gilts, yields moving lower by 11 basis points on the UK 10-year, 4.03. That is it for markets today. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone. Happy Friday. Welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Alibaba loses around 10% of its market value in Hong Kong after scrapping a plan to spin off and list its $11 billion cloud unit. Oil heads for a fourth weekly loss after entering a bear market, dragged lower by concerns over a supply glut and weaker demand. Plus, pound again under pressure after UK retail sales post a surprise drop in October. Now, let's take a look at the European markets map. It has been quite a week in terms of politics, but also in terms of some of the market movements that we've been seeing out there. A lot of the focus over the last couple of days have also been on earnings. Now, European shares opening a little bit higher overall. I guess there have been some fresh signs of economic slowdown prompting investors now to ramp up bets on interest rate cuts next year. So the focus still firmly on inflation and what central banks do, but it's very clear that there's also going to be a bit of a shift looking at some of the earnings and maybe some of the undervaluing values at some of the big companies. Now, oil prices also dropping into a bear market, some 20% lower from their September highs. Now, let's take a closer look at the markets. Joining us now is Benjamin Jones, Director of Macro Research at Invesco Asset Management, and also joining us, Bloomberg's Paul Dobson. So, Ben and Paul, thank you for joining us after quite a week, actually, that we've had overall. Ben, when you look at some of the stock's valuations, I know it's all still to do about central banks, which is why we're seeing this whipsaw. It's like, will they cut, will they not?
Yep.
But when do we go back to more fundamentals?
I think that'll be an underlying base case. And I would say that we have seen some impact of fundamentals over recent weeks. With earnings season, what you've seen is companies generally coming in with better than expected earnings, as you would expect to see, but revenues coming in quite a bit weaker, actually, some disappointments there. And where you have seen the disappointments, you've really seen those companies being hammered. So I think, yes, we get caught up in inflation, and that's clearly important. That's going to be very important for multiples. But actually, we are seeing some impact of fundamentals at the same time as well.
Yeah, Paul, are you seeing the same? I mean, you write about this day in, day out. How much of it's, will also be, I guess, on earnings and some of the underlying strengths, and not only central bank action day in, day out?
So I think going into...
let me ask Paul, and then I'll come back to you. It's like a bit of traffic. Paul.
I think that I would agree, though. It's that focus on volume versus margin and all the rest of it. Companies that have been able to pitch their pricing at the right level seem to have managed to scrape through. But it's the sort of the staples that are doing better, not the luxury goods companies, because there's this sense that the consumer is under pressure somewhat. The savings that have been sort of drawn down, and so the outlook for the consumer and for the economy isn't looking that great. And we've seen that in the likes of Walmart commentary. We've seen that in the likes of Caterpillar commentary. We've seen that in the likes of people talking about advertising spend like Trade Desk as well. So cracks starting to appear everywhere that you look. I think across the earnings spectrum this quarter.
So. Paul, when you look at oil prices dropping into a bear market, is that a sign of a worry?
I think it's the similar sort of theme. I know that there's a strong supply element in here as well, and some of the demand factors like China are kind of technical as well. But for all that, the fact that inventories are building in the US, I think also points to something of a weaker consumption pattern going on. That idea of a slowdown starting to trickle through into the market in various other places too.
Ben, when you look at the U.S. economy, will it really remain, more resilient than maybe others expected?
I think so. I think that's going to continue into next year. We know that the US economy is far less sensitive to interest rates because of two things, really. The consumer is largely on fixed rate mortgages, and although we look at these scary headline numbers of 8% mortgage rates in the US. No one really in the US is paying 8%. The effective rate is closer to about 3.5%, 3.6%, and it's barely budged from those lows that we saw last year. So the consumer's not feeling the real impact of those higher interest rates. They still have a reasonable buffer of excess savings. Again, that is unevenly distributed, but in broad aggregate terms, there is some excess savings there. And also, broadly speaking, companies have really termed out their debt. So again, there will be pressures being felt by some companies, and it's going to be very uneven. But in aggregate terms, I think we're still going to see a relatively robust path for the US into next year, whereas somewhere like Europe and certainly somewhere like the UK, which is much, much more sensitive to interest rates through the path of mortgages, through the path of variable rates on corporate debt, there is where I think the greater pressure is going to be felt.
So, Ben, do a lot of equity markets then have to catch up? I mean, there's this odd thing where actually 6 months down, we're also always expecting the worst for the U.S. economy.
Yeah.
And then actually you're seeing indicators and it goes back up, and it takes an adjustment time for the S&P and others.
It does, and look, I'm probably more positive on the US economy than I am on the Europe and certainly on the UK economy at the moment, but that doesn't directly translate into the way that I would be investing from an equity perspective. In fact, my favourite equity market at the moment would be the UK equity market, because valuations here are much, much more attractive. And ironically as well, if the UK economy weakens, and we've seen it with some of the retail sales numbers this morning, sterling weakens, that's good for those overseas companies that are listed in the UK. To a slightly lesser extent, I think the same is true of Europe. There's more valuation, or certainly more opportunities in Europe there to get attractively valued companies, where there is still a little bit of growth and where their balance sheets are fairly robust.
Interesting. Paul, what's your take actually on China? So we had the Biden-Xi meeting earlier this week. Is it about the economy or is it more about just geopolitics?
Well, a bit of both. I mean, I think that the Alibaba news that we had in the last 24 hours about them ditching plans for the IPO of the cloud business is the last thing that the market's needed right now in what was supposed to be like a positive week. You know, you have the Xi Jinping trip to the US, which I guess he would have judged to have been a success. The eco data even in China was starting to push it a little bit more positive, but the market response has not been a full-in enthusiastic buy-in. And so even in some of the companies that have been reporting more favorable earnings, the market hasn't really embraced that. There's still that skepticism that, you know, we remain to be convinced kind of perspective from investors. And I think that in order to bring back that investor confidence, we're going to need to see a lot more coming through on the policy support front and a lot more of a turn in the economic data to a more favorable kind of scenario.
But Paul, what's your take? I mean, what's the Alibaba story longer term? So this is a lack of investor appetite? Is it something wrong with the company? At the same time, we had some pretty shocking FDI figures that, you know, they're negative for the first time going into China. So there will have to possibly be things to support businesses there.
Yeah, I think from Alibaba's perspective, it's convenient in some ways to do it because the cloud business has not been growing as expected and maybe needs more capital to be injected into it. So holding it within the company may make sense, but it's disappointing for investors because they were hoping for the payout from that. That was one of the cause of the sort of strategy that the company was pursuing going forwards. I think it also, though, tells a story about the sort of pressure that the Chinese consumer tech companies are feeling, both from the sort of outside pressures in the US weighing against them, but also the internal competition. You know, margins are low, discounting has been strong. Yes, sales volumes were good over the recent boom period, but for all that, you know, it would seem due to some heavy discounting, and so that's not necessarily a rosy picture overall for the companies or for the economy.
Yeah, Ben, what's your take on China? How do you play China, actually, given all of this?
Yeah, with difficulty. I mean, I certainly wouldn't be jumping into China and just buying the index blindly at the moment. I think it's much more about getting those selective opportunities right now. And I think Paul's right. We would need to see broad-based, big policy action to get us to want to dive in with a more sort of broad-based fashion. But I think if you look at what particularly Xi Jinping and the Chinese authorities are saying, it's less about the economy right now. It's much, much more about security right now. And that, for me, means we're not going to go back to the period that we saw sort of 2015 before the COVID pandemic, where you got some weakness and you got this flood of liquidity, this flood of stimulus into the economy. It's going to be a lot more piecemeal. It's going to be a lot more nuanced. It's going to be a lot more precise. Now, one way I was originally thinking about this is, well, perhaps you then go and you buy those areas that the Chinese authorities are trying to support, perhaps the domestic industrial space, health, those sort of things. But actually, I think that's probably the wrong way to think about it. What I think you maybe want to do is avoid the areas that are most at risk of regulation, and you want to avoid those areas that are perhaps most at risk of getting the influx of capital from the authorities, because that's where there's the chance of a misallocation of capital. Whereas if you go down sort of the middle route, where those areas are that are kind of just going to be not looked at by authorities, both from a positive and a negative stance, then you're likely to get better allocation to capital. So that's more of some of the consumer domestic areas, some of the autos areas as well, which are doing very well at the moment, and we're seeing them really grab market share in China. So, look, I'm not a stock picker, but I think China is a stock picker's universe at the moment, rather than someone that goes and says, look, I'm just going to go and buy the Chinese index today.
So interesting, Ben. Thank you so much for joining us. Benjamin Jones, their Director of Macro Research at Invesco Asset Management. And thank you as well to Bloomberg's Paul Dobson. Now, we're just getting a bit of breaking news out of Applied Materials. It's 9:10 a.m. UK time, which means that usually you get this pre-market check. It's one of my favorite things to do all day because it really gives you an indication of, I guess, the reaction of investors to some of our top stories. So Applied Materials, the largest U.S. maker of chip-making machinery, of course, is down 6.8% following a report that it faces a U.S. criminal investigation for allegedly violating export restrictions to China. We'll continue following Applied Materials very, very closely. Pre-market, that share price just opened. Coming up, Alibaba shares closed about 10% lower in Hong Kong trade. So what's on the horizon for the Chinese tech giant? We'll discuss that next. And this is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This, at first glance, is just a smartphone. But once you know what's inside, it becomes clear it's so much more than that.
So what really changed everybody's view of this device was what was at the heart of it.
the microprocessor that was designed and manufactured in China.
It's at the center of tensions between the world's two biggest economies. The phone made by Chinese tech giant Huawei represents a breakthrough by Beijing as it tries to escape Washington's controls on its access to technology and establish a self-sufficient chip industry. If those U.S. controls had been successful, then a smartphone as advanced as this simply should not be possible without importing key components.
China now is more capable than ever of building advanced technologies.
And it worried U.S. officials who are more concerned about advanced chips going into military equipment than smartphones. It left them wondering, how exactly did China do it?
So that's Bloomberg's mini documentary, When Huawei Shocked America with a Smartphone. You can watch the full version on your Bloomberg terminal, on Bloomberg.com, or on our social media. You don't want to miss one. It's really a great piece. Now, staying with U.S.-China tech tensions, and $20 billion has been wiped off the market value of Alibaba. This comes after the e-commerce giant scrapped plans to list its $11 billion cloud business. Well, Robert Lee from our Bloomberg intelligence team joins us. And Robert, scrapping the plan isn't a complete surprise, but why has the market actually reacted so severely?
Yeah, well, as you said in your intro, I think there were two things, really. The numbers themselves, that quarterly results sort of confirmed existing concerns about rising competitive pressures in China's e-commerce sector, and also looking forward, the scope for a weaker consumer into next year. But those are not new concerns. As you mentioned, what drove the stock down nearly 10% locally here in Hong Kong today was the fact that they've pulled the IPO plans, or at least put them on ice for the time being. Why did they want to IPO and spin off these various businesses in the first place? Well, Alibaba is a conglomerate, and it suffers a conglomerate discount. The stock has been far from the best performer locally or globally over the recent past, and therefore the logic behind the spin-offs was to return value to shareholder, going along the logic that the sum of the parts is greater than the whole. So this apparently shock announcement to the market that they are now pulling the IPO plans, has come as a major surprise. But I do think there were some warning signs there beforehand.
So overall, why did Alibaba actually pull the cloud IPO?
Yeah, well, I guess I asked a bit of a rhetorical question there. The warning signs were, first of all, that Daniel Zhang took over the CEO role in the summer of this year. Within 3 months, he walked away from that role without any proper explanation. So for your newly appointed CEO to be moving, just ahead of a potential IPO, obviously raised some fundamental questions about what's going on in the company. But secondly, if you look at the actual numbers that Alibaba Cloud's business has been reporting in the last few quarters, or in fact, for a longer period than that, there are two things. One is the company's been losing market share in a viciously competitive cloud sector in China, along with its main peer and rival Tencent. And secondly, the revenue growth that the company's been delivering has almost come to a complete standstill. So, for example, in the quarterly results they published last night, the annual revenue growth in the cloud business was just 2%. So investors, what a growth story to get their teeth into when a company IPOs. Mm-hmm. The growth story is just not there with Alibaba Cloud at this point in time.
Robert, thank you so much. Robert Lee there from Bloomberg Intelligence in Hong Kong. Now, UK retail sales fell unexpectedly in October, with retailers blaming the cost of living crisis and bad weather for the poor performance. Economists were forecasting a rise of 0.4% for the month. Instead, sales fell to their lowest level since February 2021, when COVID restrictions were in place. Well, joining us now is Anna Andrade from Bloomberg Economics. Thank you, Anna, for joining us as always. I mean, this is a bit of a weird one. If you look at retail sales, they weren't great. So what does it tell us about the UK economy?
Hi, good morning. So yeah, the retail sales number is kind of the first data we had for the fourth quarter, and it doesn't suggest that it was a good start to the quarter. You could blame the weather a bit, but I mean, I think the most likely story is one of sustained weakness in the economy. And the reason why I'm saying that is that in the GDP release we had last week, we already saw private consumption falling on a quarterly basis. So that's there. And we know kind of that the impact from past tightening from the BOE is landing now, and there's still more to come. So I think, it doesn't look great.
So, Anna, is the economy weakening enough so that inflation continues to go down? I guess that's the million-dollar question for the BOE.
Yeah, I mean, that's exactly it. That's the question. I mean, if you think that trend growth in the UK economy is 0.3% quarter on quarter, anything below that will kind of add to these inflationary pressures. But the question is that the BOE wants to get to 2% in a very timely manner. And the question is whether if the economy continues to stagnate, that will kind of then, bring inflation down. The experience for the past year is that it won't. An economy that's stagnating, a labor market that's resilient, it won't help in bringing inflation down. So our view has been for a while that more weakness is needed and that this mild downturn that we're forecasting will kind of help a bit the BOE in getting to 2%, but that's only in kind of early 2025.
So when can we expect cuts? I know we also had this interview with Megan Green yesterday. She was really pushing back against any cuts that are even priced in the markets.
Yeah, I mean, our view has been that the first cut is likely to come in August. The BOE will have to balance two things, a weakening economy and inflation remaining kind of above target. Now, because of the experience of the past year and they tried so hard to bring inflation back under control, we think that they won't let go before there's significant progress in inflation. Now, that doesn't mean that they will only cut when it hits 2%, because, again, that's early 2025. But it might mean that, by the time it gets to 3%, and if the economy is weakening, there might be, an opportunity there to cut rates.
Anna, thank you so much, as always. Bloomberg Economics, Anna Andrade there. Now, plenty more to come. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
I think each of the races has a different character, and they're very have characteristics which make them unique and special and all worthy. I do think Vegas is going to be unique in that it's a night race down the strip on a Saturday night. I think it's going to be iconic. The visuals will be amazing. And I am not worried about demand because we have been lucky enough to see interest in Formula One explode here in the U.S.
That was Liberty Media's chief executive remaining upbeat about the F1 race in Las Vegas this weekend. The company which owns F1 has poured hundreds of millions of dollars into building the street track and infrastructure around the city's famous strip. But hotel room rates and ticket prices have been tumbling leading up to the weekend race, with organizers actually struggling to sell the last remaining seats. Now here is what else we're looking at for today. At 10 a.m. UK time, we get the final CPI reading for the euro area. U.S. housing starts data actually comes in at 1:30 p.m. UK time. And then finally in the afternoon, we'll also hear from a slew of central bank speakers from the European Banking Congress. Now, a couple of things that we need to watch out for is Applied Materials, lower pre-market, that pre-market share price. Actually opening just about 30 minutes ago, less than 30 minutes, maybe 20 minutes ago. So this is the largest U.S. maker of chip-making machinery, down 7%. This follows a report that it faces a U.S. criminal investigation for allegedly violating export restrictions to China. So we'll have a full roundup, of course, on that shortly. Coming up, Spain's Prime Minister Pedro Sánchez wins re-election, but the socialist leader is starting his new term facing a strong backlash. We discuss that next, and this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Alibaba loses around 10% of its market value in Hong Kong after scrapping a plan to spin off and list its $11 billion cloud unit. Oil heads for a fourth weekly loss after entering a bear market, dragged lower by concerns over a supply glut and weaker demand. Plus, the pound is again under pressure after UK retail sales post a surprise drop in October. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the French Finance Minister Bruno Le Maire will travel to Germany this afternoon to discuss reforming the EU Stability Pact. This comes as the euro area's two most important economies look for agreement on new fiscal rules. Now, for more, let's bring in Bloomberg's Maria Tadeo in Brussels. Good morning, Maria. So, Le Maire meets Lindner. What's the goal there?
Yes, Francine, it is about fiscal rules. We are finally talking about fiscal rules because this is a story that has played almost as a slow burner in the background, very under the radar. But as you know, the fiscal rules famously or infamously, depending on who you ask, is one of the key pillars, essentially, of economic governance in the euro area. Now, by now, it is understood they were suspended when the pandemic struck. They will be reinstated next year. But if they are reinstated the way they work at this point, some countries will be in for a severe adjustment. So the goal now is to get to a reform of the fiscal rules that can accommodate both sides of this debate. And it's interesting this bilateral meeting is happening today between the French finance minister and the German finance minister because they really exemplify the two sides of the debate. It is also understood at this point, Francine, that unless they agree, unless the French and the Germans agree on the basis of a new reform for fiscal rules, this will not move at a European level. And the clock is ticking because they have to agree before the end of the year. Essentially, you have 5 weeks left, and you also have pressure from the European Central Bank. The head of the ECB was clear on this, that she wants to see this fiscal reform done before the end of the year. What I am being told just briefly is that the mood between the French delegation and the German delegation, I'm told it is excellent, it is constructive, and they believe even if there's no breakthrough today, they are getting close to one.
So Lindner, German finance minister, also hit by this constitutional court ruling this week. So what's next, Maria?
Yeah, and it is a lot to his credibility, his reputation, and not just the finance ministry, but also the economy ministry that's handled by Robert Habeck and the entire coalition. Now, Francine, obviously we know this week we had the story from that constitutional court ruling suggesting that Germany could not use off-budget funding into the climate transition. Bloomberg also has a story that is a headache because potentially you could see up to 700 billion euros that could be questioned in that way. But when it comes specifically to Lindner, it is interesting that he has taken a different tone, saying that this ruling is a moment of clarity, it is a turning point, and it shows that Germany has to set its priorities now, perhaps more carefully, and it is not a question of throwing more money to the problem. And that is something that we hear from Lindner, both in Germany, but also in the European Union. Remember, he said many times in Brussels, he does not see the need for further funding. It's about value for money.
Maria, thank you so much. As always, Bloomberg's Maria Tadeo there in Brussels. Now, sticking with Europe, Pedro Sanchez has won re-election as Spain's prime minister in a confidence vote yesterday. The decision to re-elect Sanchez ends months of uncertainty after an inconclusive election back in July. Well, joining us now is Bloomberg's Rodrigo Orihuela, live in Madrid. Rodrigo, always good to speak to you. So talk to us a little bit about how Sanchez actually got this majority and why it's so controversial.
So he got the majority by signing an agreement to pass an amnesty deal for hundreds of Catalan activists, as we've been telling, over the last few months. This is very controversial, as you say, because for a lot of people in Spain, these pro-independence activists should have gone to court because they broke the law in several different ways, and they do not endorse the fact that he's pushing through this amnesty. This took a long negotiation. It's going to be approved, and to get voted for a new term, he needed support from 8 different parties in Parliament. Most of these are different types of nationalist parties, pro-independence parties. One of them is obviously Junts per Catalunya, which is the best known Catalan independence movement right now. And that's where the controversy stems, from the fact that he was willing to exchange support for an amnesty for hundreds of people who had criminal cases against them.
So what can we actually expect from Sanchez and his next term in office?
So that group of 8 parties that has voted for him has 2 things in common. One, they all proclaim to be staunchly against the far right. That's one of the gels that keeps them together. But the other thing that they have in common is that there's a vast variety of people. There are several parties that are far, far left, 3 or 4 of those. There are 2 who are, you could argue, center left. And there are 2 who are pro-independence, but very pro-business as well. Especially one of them is very pro-business. And he will need support from this entire base to get legislation through. So the big question is, how will he be able to convince all these parties to vote with him? Especially because some of his agenda is quite far onto the left, very pro-worker, anti-business, and it's not very clear how he is going to muster that support.
Okay, Rodrigo, thanks so much. Rodrigo Orihuela there in Madrid. Now let's get some other top read stories on the Bloomberg terminal. And international pressure on Israel is growing, with the U.S. and its European allies pushing a peacekeeping plan. This comes after the Prime Minister, Benjamin Netanyahu, says Israeli forces have found a Hamas command center under the Shifa hospital in Gaza. Now, the average tax collected per UK bank employee jumped by more than 11% in 2022 compared to the previous year. Now, the new data comes from a survey of the sector by trade association UK Finance. On average, the government now collects more than £42,000 a year in tax per bank employee, with increases largely due to government freezing income tax thresholds and a temporary increase in national insurance. Now, Bloomberg understands that Apple has fallen further behind in its multi-billion-dollar effort to make a modem chip for the iPhone. The company will likely miss its 2025 goal to roll out its own cellular modem as it struggles with the complex task of replacing the current Qualcomm technology. Coming up, the Turkish President Erdogan is set to arrive in Berlin today and meet with the German Chancellor Olaf Scholz. We'll discuss what's next on the agenda, as well as other insights with Neil Schmidt. He's foreign policy representative from Germany's Social Democratic Party. That's next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now let's take a look at the European markets map. Overall, we're seeing gains across the board. A lot of the focus, once again, on some of the negative economic data that we've had and whether that pushes either cuts from central banks or just no longer any interest rate rises. So again, European shares opening higher. We had those fresh signs of an economic slowdown, really prompting investors to ramp up some of these bets on interest rate cuts next year. Now, this jobs, soft inflation, but also jobs data in the U.S. has pretty much fueled conviction that aggressive policy tightening cycles from the Fed and other central bankers could finally come to an end. In other news, German Chancellor Olaf Scholz is set to meet with the Turkish President Erdogan this afternoon in Berlin. Amid the war in Ukraine and the Middle East, Berlin has described the trip as, quote, a visit by a difficult partner. So let's get straight to Bloomberg's Oliver Crook in Berlin for more, who's joined by a guest. Ollie.
That's right, Francine. Thank you so much. I'm joined by Niels Schmid. He's the foreign policy representative for the German Social Democrats. This is, of course, the ruling party here in Germany, chaired by Chancellor Scholz. Niels, thank you so much for joining us today. And so in your position as sort of the chief foreign policy lawmaker for the SPD, it's an important day. You have Erdogan coming here today. It is hard to imagine two leaders with a more distant view on the conflict in Israel between Chancellor Scholz and Erdogan. Is there any common ground? What progress can be made? What can we expect from the talks today?
With regard to Hamas, there is no common ground, and we will see to which extent Erdogan's posturing was tactical, or is it a real political conviction? We've seen similar outbursts by Erdogan in the past, and after some time he came back to a very pragmatic approach, normalizing ties with Israel and so on. But on the substance, this is a profound divergency, and Erdogan will face some harsh criticism by Scholz. Yeah.
And in terms of that pragmatism, do you think that he will come to pragmatism on the topic of NATO and Sweden's ascent into NATO? Where do you see that happen?
I very much hope so. We've seen another postponement of the decision to be made by the Turkish parliament, but in the end, Erdogan can play his regional role only thanks to Turkey being part of the NATO alliance. Otherwise, Turkey would become less interesting to Russia or any other actor in the region. So yes, in the end, we will see a vote by the Turkish parliament.
Yeah. And in a military alliance, and it's no secret that the Erdogan would like some European fighter jets. This is something that has been vetoed by the Germans. Is there anything that he could do, talking to that pragmatism, to get that veto lifted?
I don't think so, because there's a strong opposition inside the German parliament on that account. Americans are still blocking any sale of F-16 or even F-35 fighter planes. And as long as Turkey attacks SDF forces in northern Syria and occupies territory there, which is against international law, I do not see how we can find a common ground on that account. On other topics, there might be an agreement because we have converging interests when it comes to immigration, for example.
Well, that's what I wanted to focus on. What progress do you think can be made on immigration? Scholz has made this almost very top of the list as a priority now in dealing with the immigration in Germany. What is Turkey's role in that?
Well, for Turkey, especially for Erdogan and his party, this is also a top priority because they're going to face local elections next spring. And dealing with refugees in Turkey has become a major issue, especially after the Turkish economy broke down. So sustaining millions of Syrian refugees in Turkey is quite a feat, and that deserves support from the European Union. Since the refugees are still in Turkey, we should continue funding Turkey for helping these refugees. I think a prolongation, a revitalization of this EU-Turkey agreement on refugees is in the making, And this will be very much on top of the list today.
And in the West and in NATO and many of the Western nations, there seems to be a unified voice on the topic of Israel and the right to defend itself. Where there seems to be a little bit of disagreement and a conversation evolving is where the limits to that self-defense are. We heard Emmanuel Macron calling for a ceasefire. This is not something we've heard from a lot of the allies of Israel. Where do you see that diverging within the West? And do you worry about, given Germany's position, support for Israel diminishing?
Not really. We are dedicated to supporting Israel and defending the existence of the State of Israel. We are also committed to this two-state solution. So in the end, we need a political perspective. And this is a very much unifying position inside the European Union. I think the UN Security Council's vote on humanitarian pauses was really helpful, and we should continue on this path.
I have to say that I was in Israel for a long period of time now covering the war, and we hear a lot about the two-state solution from everywhere across the world. I did not hear a lot about it within Israel.
That's a problem, by the way.
Well, yeah,
this has been a problem for some years now, and maybe we need a change in the political leadership in Israel following this surprise attack by Hamas on Israel. And there's a debate about political and also military responsibility inside Israel, which once again demonstrates the vitality of the Israeli democracy. And we will have to see if the Israeli government or a possible new Israeli government is more open to this kind of political process.
And do you take a view on sort of more medium term of what should be happening in Gaza after the sort of most forceful bit of the military operation is concluded? Netanyahu talks about an indefinite security control over Gaza. Do you have a view of what should replace that regime?
Well, I do not see any Israeli reoccupation of Gaza happening. This is very much opposed by Americans and by the international community. Maybe we should find a transitional regime implying the international community. It will be very complicated, but I sense that continuous international support for the solution of the conflict in Gaza, but also for a political solution, is very much needed. And I hope that the Americans will not turn back to their passivity. But I also want to stress that the Europeans, and especially Germany, need also to remain engaged in this conflict.
And talking about the other war that's going on, and again, it's sort of surprising that we could go talk so long and not talk about Ukraine and Russia, but it sort of demonstrates a bit of kind of the view of what's going on there. Germany was very late to send the tanks. They eventually decided to do so. Do you fear that there's something similar happening with the fighter jets? Is this not just sort of doomed to stalemate and just to grinding on if there's not some major step up in support for Ukraine?
So let me first of all emphasize that the German support might have come a little bit late, but it's very steadfast. And you can count on Germany to continue military support to Ukraine even after the next general election, because there's a big majority inside parliament, including the opposition Christian Democrats. And we will see what will happen, I would say, in 1 year time when ammunition and armament production in Europe has picked up. Unfortunately, it takes a little bit too long. We had expected to have 1 million rounds of ammunition ready by this year. But in the end, Ukraine will benefit from our increased weapons production, since we are committed to continue our deliveries.
And I want to sort of tie this all together and step back and think about this, because these conflicts have sort of drawn new alignments within the geopolitical stage in the world between Russia, China, Iran supplying Russia with a huge amount of military gear. Do you see that as just a sort of allies of convenience, or do you see this as a durable change in the geopolitical order, and how should Germany respond?
I would assess it as a tactical alliance. It's not a sort of a very strong alliance of anti-Western forces, but the war of Russia against Ukraine has created opportunities, for example, for Iran to break international isolation. What is of more concern to us is a divergence of appreciation which has become very visible with regard to the Israeli-Palestine conflict. Many countries in Asia, Africa, and Latin America have a very different opinion on that. And we will have to fight hard in the international community and have to do a lot of diplomatic outreach to make them understand that Israel is the victim of a brutal aggression, and that at the same time we care for the plight of the Palestinians and we prepare the ground for a political solution. But that's much more difficult than in the case of Ukraine, where diplomatic outreach has won a lot of votes in the UN General Assembly, for example.
And it's interesting also some of the lines it has caused within domestic politics within the West. But on that, we'll have to pick it up another time. Niels Schmid, thank you so much, the Chief Lawmaker for Foreign Policy of the SPD.
Oliver, thank you. Oliver Crook there with a terrific conversation, of course, on the way forward. Coming up, we look at today's big take story on China's military strength in question. That's next, and this is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the Shadow Fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The scale of AI research talent in China is just simply astounding to see. So I think in some ways this question, China is going to be at the forefront of AI, and I think that's a given.
Well, that was the Alphabet chief executive, Sundar Pichai, speaking to, of course, Bloomberg in San Francisco about the importance of U.S. and China collaboration when it comes to regulation and innovation. Now, China's military is the focus of today's Bloomberg Big Take story. Beijing has spent years and billions of dollars building advanced weaponry and modernizing its forces, but there are doubts that the People's Liberation Army is ready for battle. Now, Bloomberg's Bill Ferries joins us to discuss all of this. Bill, so what lessons has China actually learned from the Ukraine war?
Well, it's interesting. We dug into a lot of documents produced by the People's Liberation Army and analysts who are close to the Chinese military, who are watching the Ukraine war, Russia's war in Ukraine very carefully. and they're raising a lot of red flags that apply to their own military. Things like Russia's plans to have a quick invasion in early last year that would topple the government in Kyiv and effectively replace the government. Russia's inability to have different branches of its services coordinate effectively on the ground. So the troops on the ground, they're not working well with the air power in the skies above them. All of these things that has made this process in Ukraine draw to a stalemate so far. These are the worries that China has when they look at what will happen if they try to take Taiwan militarily.
So what does this actually mean for the likelihood of a conflict over Taiwan?
So what we've seen is that China is very concerned that it not face any setbacks. It does not. It looks at the Ukraine model as kind of their worst case scenario. And I think in many ways that probably works to Taiwan's advantage and to the U.S. advantage. If the Chinese government doesn't think it can have an overpowering win in a place like Taiwan, it is probably less likely to go for that kind of a strategy. The feeling is, among many of the analysts we talk to, both within and outside of China, is that they need some certainty before they go forward with this. China's government wants its military to be capable of taking Taiwan by 2027, but that doesn't mean they're planning to do anything in 2027 or even in the years afterwards. What our research has shown, looking at China's own comments about its military, is that they don't think they're there yet, and that capability is probably years away.
Bill, thank you so much. Bill Ferry's there with the very latest, of course, on this great, important Big Take. You can read today's Big Take on Bloomberg.com or just go to NI Big Take on your Bloomberg terminal. Up next, quite a lot going on, of course, when it comes to geopolitics. It's been quite a week also for UK politics. Now, we'll have a full roundup of the top news. Also, this is what stocks are doing today. Now, stocks and bonds seem to be rallying again on this rate cut conviction. When you look at some of the fresh signs that we've had this week, certainly in terms of economic data or economic slowdown, that seems to have prompted investors to ramp up bets on interest rate cuts next year. And then oil. That, of course, oil prices dropping into a bear market, down some 20% from their September highs. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
In London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
President Xi vows to take heartwarming steps to attract foreign companies, while President Biden says much of the world's history in the coming years will be written in Asia. Oil sinks into a bear market, crude collapses on signs of healthy supplies, rising stockpiles offsetting the Saudi and Russian efforts to keep declines in check. And the chip war spurs breakup rethink at Alibaba as Applied Materials faces a U.S. criminal probe for allegedly violating export restrictions to China. A very good morning. There are cracks in the global data structure, from the UK retail sales to the jobs data in the United States of America. And this is the repercussion. 5 days, it's a bit like running with the bulls at Pamplona. That's what this bond market really feels like. 26 basis points in the space of 5 days. And we're not done yet. As I say, the question is, how much more momentum will you have in this bond market? We're at 4.39% at the moment. We give a couple of pips back. It is 26 basis points for the week, and it is those cracks in the data. The jobless claims, the highest in 2 years, rising for an 8th week in a row. Home builder sentiment, that's tracking the lows of 2023. And Bank of America in the flow show the first glimmers of outflows since February 2023. Now, when it comes to the money markets, we'll talk about those a little bit more detail. There's 5.73 trillion going into money market funds. On the oil market, we're bouncing back from this implosion. We were down over 5.6% yesterday. 4th week of losses, depending on what we can put on the board today. I mean, we are gripped. This market is gripped by what happens in Vienna in 10 days' time. We're down 20% from the highs. Did the algos really trash the market? That is going to upset the Saudis, because Prince Abdulaziz bin Salman, he loathes the speculators, of which algos are a part of. Goldman Sachs, of course, warned that there's a lot more flow coming from non-OPEC, and that is delivering an exaggerated negative sentiment. Now, when it comes to the pound, we're flat at the moment, but again, it's the cracks in the data that I bring you to. Retail sales unexpectedly fell by 0.3%, and a massive revision to the previous month of 1.1%. So we're seeing these bunds and bonds all move. Danny, good morning.
Good morning, Manus. And it's a week where we just had to bow to our robot overlords, because it wasn't just the algos and oil that apparently shook things up. In this equity market, Goldman Sachs says that the CTA, so the momentum quant-type traders, bought a record $7 billion worth of American equity over the past 10 days. The gains continue, at least for S&P 500 futures, up 0.2% today. They were slightly higher yesterday, on track for 4th consecutive day of gains. NASDAQ underperforming, basically flat at the moment. It's those concerns about chips. 20 billion wiped off of Alibaba yesterday in the pre-market session. Applied Materials, that is falling, weighing on the index over reports of a U.S. criminal probe. And finally, Manus, European stocks, those are moving higher by 1%. We've talked a lot about how American stocks are taking heart in the fact that cuts are priced in. The same is happening for Europe. We have now priced in a full percentage points of cuts from the ECB for 2024. But Manus, when we talk about the flows and where the money is going, it is remarkable to see the amount of money being poured into equities. At the moment, the S&P is on track for its best month. It's added $2.8 trillion in market value over that time. And the flow show just out from Bank of America said that this past week, U.S. stock funds, global stock funds rather, have seen their second best inflow of the year.
Yeah, I just want to come back as a CTA. Goldman's are saying 70 billion went in. I mean, I want to reincarnate myself as many things, a junior banker being one of them. But what 70 billion bucks went into the CTAs? That's in the last 10 days, the largest on record. So where do you want to hide? Money market funds. I can't open a money market fund. I do not exist in this country. I am trying desperately to open a money market fund at one institution. Have a look at this. This is the flow of money in terms of the flow into money market funds. 5.73 trillion, nearly 22 billion went in last week. So what you got there, Danny, is a monster move. I've not participated in that.
I feel like you're Vanna White right now. You talked about the chart and it appeared in front of you, and I even did like the hand motions. I don't know why I did that.
That wasn't supposed to go that way. But anyway, we got to Friday. We didn't break anything. The question is, what happens with the bond market? That was very well done, Danny.
Thank you. Thank you. Do you want to buy a vowel?
I just want a money market fund account open, really, to tell you the truth. If I can exist in the USA, we'll make progress. Let's move it along. PIMCO, they're anticipating another corner of the market to do well. They're renewing their bullish bond forecast for the new year, writing, quote, current valuations and an outlook for challenging economic growth, diminishing inflation. We believe bonds are rarely appeared more compelling than equities. Geraldine Sundstrom and the team at PIMCO put the note out, portfolio manager. Now, Geraldine, what goes through Danny and I's mind? We were looking at this marvelous quote. We know that you've said this before at the start of the year. It didn't go so well. But what kind of hard landing do you need to see to deliver that outperformance of the bonds to equity spread? Good morning.
Good morning. Well, we don't think that you need a hard landing at all. The best predictor of bond return is the current yield, and at the moment, with yield where they are, even out on the belly of the curve in the US or other countries in Europe, the expected returns are looking good. If you have a bit of a harder landing than the market is pricing, then those returns will be even higher, whereas equities, where the equity risk premium is at the moment, will struggle to beat those type of returns. So, and even if inflation were to be quite sticky, you have quite a lot of protection for higher yield embedded with this type of carry at the moment.
Well, you're talking about the equity risk premium. If stocks are going to struggle, Geraldine, in 2024, just how bad does it get?
We don't think there is going to be a hard landing. We think there's a sort of a toss of a coin if we get a recession or not in 2024. So we're a little bit more cautious than consensus out there. Yeah, so I think actually, I forgot your question. I'm sorry, it's Friday.
Geraldine, honestly, I do the same thing all the time. Don't tell Manus. Don't tell Manus. Sometimes he says stuff to me and I've forgotten what he said. But I wanted to know specifically about stocks. In these two scenarios you've laid out, and necessarily we don't get a hard landing, maybe we do, it's a coin toss. How ugly does it get out there for stocks if we do get to that hard landing?
No, I think so. Earnings expectation for next year are still quite elevated. I mean, earnings see some acceleration of the economy, which is a sort of dichotomy versus our expectation of growth slowing down. So we think we're going to continue to see disappointment in terms of earnings consensus next year. That said, you know, it's not a hard landing. If there is a recession, it's going to be a mild one. But you could definitely see a correction. Multiples are pretty elevated. especially with the Magnificent Seven. There are other markets which are much more fairly valued out there. And it's hard to see this market with like a really big broadening rally beyond some secular area or tech-related area that are still seeing a lot of growth. So we're cautious, but we're not calling for a crash of the market.
Okay, so maybe a correction, a little bit of pressure on stocks, no dramatically hard landing. So let's translate that into credit. You're quite bullish on bonds. We know that, the belly of the curve. We got that message loud and clear. Let's talk about the probability. Late cycle is where you say we are, 50% probability of a recession. If we are late cycle, and Danny and I were chatting about this yesterday, we looked at Moody's this morning. They say speculative corporate defaults are running at 5%. Now, that's the highest since 2021. What we want to know is what kind of default cycle are we going to get in 2024? Where is that going to be most pronounced in terms of the spreads? Do we blow out? And how aggressively do we blow out?
So we really recommend to go up the quality, be it in equities or credit. And stir away from the more cyclical, much more interest rate sensitive sector, which could have a hard time. The good news, though, is that during the very low interest rates, companies have turned out their debt pretty far out. So the wall of maturity is not necessarily going to come right here, right now, and is going to be much more gradual, especially towards 2025. So there's not necessarily going to be a big credit cycle like we're used to. Companies have been very clever during the very low levels of interest rates, but that's not a recommendation to go for junk credit. We really stay in securitized part of the credit market, high quality, investment grade, and certainly not in sectors that are very sensitive to interest rates.
Geraldine, it's been a year of a lot of soul searching for the bond bulls. I know PIMCO and your team were among those that said bonds are back. You're not the only one. A lot of people got this wrong. Where did that soul searching lead you to? What do you think's been the biggest miscalculation this year?
Well, I think the transmission of monetary policy probably did not work as we thought. There was a lot more structural savings that were there, so the consumer was very resilient, mortgaged or very fixed rather than floating in many economies. And so we feel it's much more like the delay, things taking longer to happen because of the series of supply shock and demand shock that we have. But eventually, as time goes by, we do see things roll over. And of course, when you look at Europe, you see that we are flirting with recession, that you see the data in the UK this morning. Those economies are a lot more sensitive to interest rates, and we see the result there. So the US has been a bit of an exception out there, but as time goes by, we will see where the convergence occur, and we would think that the convergence is more likely to be towards more slowing in the US than acceleration in the rest of the world.
So Geraldine, I mean, you've touched on the big news points this morning. Slowdown in the UK, jobs data in the USA rising, but you are underweight duration in Japan. I'm just trying to close off this conversation this morning. I could be long the belly in the US, I could be long gilts, or I could be long of Japan. Where are you materially changing your allocation? Is it the big bond event that we're all anticipating in Japan? Your call across the three assets this morning.
Well, we think that the risk reward in Japan, given the low level of yield, given that the yield curve control has not really been dealt with, is rather poor. So we prefer to be in those areas that should there be a harder landing and consensus be wrong, you actually do get protection. You do get diversification in your portfolio. And you can find this a lot more in the dollar block. That could also be countries like Australia, which are, in our view, more sensitive to interest rates than the US in terms of an economy, or the UK for that matter. And a bit, willing to go a little bit out on this curve because you don't really lose so much. The curves used to be very inverted. So going out, in the belly of the curve was a costly exercise relative to money market.
Right.
But these days, curves are a lot flatter. So it's good to go out on that curve, get the real protection, because in money market, you don't have this duration, you don't have this lever effect that will protect your portfolio.
Maybe it's protection myself. Yeah, I can't open the money market fund, Geraldine.
I was going to say, you know, it's good news for Manus because he's been struggling. The U.S. literally doesn't recognize him as a whole human being. It's very sad. Geraldine, I'm afraid that's all we have time for. Thank you so much for joining us on this Friday morning. Enjoy your weekend. That's PIMCO's Geraldine Sundstrom. Now let's get to some other top stories that are trending on the terminal this morning. International pressure on Israel is growing, with the U.S. and its European allies pushing a peacekeeping plan. This after Prime Minister Benjamin Netanyahu says Israeli forces have found a Hamas command center under the Shifa hospital in Gaza City.
Walgreens will close most of its stores and pharmacies on Thanksgiving Day. That will give thousands of workers an unexpected day off amid walkouts and layoffs.
Bloomberg has learned that Apple has fallen further behind in its multi-billion-dollar effort to make a modern chip for the iPhone. The company will likely miss its 2025 goal to roll out its own cellular modem as it struggles with the complex process of replacing the current Qualcomm technology.
Okay, well, we won't get dragged down in the Apple experience I've had this week. Coming up, we will delve into the fourth week of losses, sinking into a bear market. We discuss the ramifications for the OPEC meeting in Vienna, right here on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Now, oil is headed for a fourth weekly loss. It sunk into a bear market, getting beat up yesterday, falling by nearly 5%. Joining us now is Bloomberg's Will Kennedy. Will, I told you this during the break, and I feel like I should just let our audience know this too. When I saw oil price this morning, I phoned up Manus and I said, what happened? And he told me 5 different things, and I've forgotten them all. So what is the biggest reason that oil moved?
Well, what we had yesterday is we had a small uptick in inventories in the US, and I think that triggered some selling and clearly accelerated. Whether that was algorithmic sellers, as some people were speculating this morning, I don't think is necessarily totally clear. I think there is a bigger picture here, though, which is the market is adjusting to the fact that while demand has held up very strong this year, supply has also been very strong, and we've seen oil from shale more than people expected. We've seen a lot of oil from Latin America, Guyana, and Brazil, and Russia is exporting quite strongly, and so that demand has been met by supply, and it's putting prices under pressure.
Well, good to see you this morning. I mean, I watched Amos Hochstein with Anne-Marie, and he really sort of like tried to back, oh, Venezuela supply, Anne-Marie, it's really not that much, you know, relative to where it was. And no, we're not going soft on Iran, Anne-Marie. You know, you could hear the White House narrative trying to push back. They want low gas prices. They want lower prices. I'm just wondering how much of a juxtaposition we face as we go to Vienna, which is the Saudis and the Russians committing to extending their unilateral cuts to the end of the year. Is there more pressure now than ever, Will, to see something extended into Q1 2024 when we're in Vienna next week?
I mean, that's absolutely where the conversation is headed, Manus. Do the Saudis keep those voluntary cuts into 2024, and how long? I think the market expects them to do that at this point. The Saudis, to be fair, haven't said anything about it, but I think a lot of people in the market have been saying they expect them to do that, because when you look at the balances for early next year, they need to do that if they want to keep prices close to where they are now. And then the question is, for how long do they have to do it? And I think that's really going to be the focus for the OPEC meeting next weekend.
Beyond just the supply issue, and when it comes to OPEC, how much of this is about demand right now, Will?
Yeah, as I said, demand has been very robust this year, and a lot of that has come from China, because this is the first year that China's been out of COVID. So you've seen an even healthier than normal uptick in Chinese supply. That effect won't be repeated, and of course there is concern about how strong the Chinese economy is, so you won't get that huge bump in supply, and there is a lot of nervousness about the economic outlook. You know, inflation is dropping, but it's a good thing, but does that signal a softening in the economy? How strong will demand be next year? The European economy looks quite weak, so I think people are assessing their balances for next year. The other point to make about OPEC is that under the current deal, the UAE will be able to put another 200,000 barrels or so into the market. So there's a bit more supply to come there. So people are really doing their calculations for next year, and they're seeing that the market doesn't necessarily look incredibly tight. And if you get softer than expected demand, then it might look even less tight.
Right. Yeah, I mean, that really is the pressure point. Okay, well, Will Kennedy there join us, our global head of commodities. Speaking of which, let's just check in on the price of Brent and WTI. As Danny was just saying, back in a bear market. Goldman Sachs are talking about the non-OPEC supply. Will chipping in on that as well. We're down 20% from the highs. We bounced back by over 1% this morning. Iron ore going actually, I mean, it's given a little bit back this morning, but on the week, we've had 4 weeks of gains. I mean, we've had a cracking run on iron ore.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need we need investment support because we are the best investment case for this in the world.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think each of the races has a different character, and they're very have characteristics which make them unique and special and all worthy. I do think Vegas is going to be unique in that it's a night race down the strip on a Saturday night. I think it's going to be iconic. The visuals will be amazing, and I am not worried about demand because we have been lucky enough to see interest in Formula One explode here in the U.S.
That was Greg Maffei, CEO of Formula One's parent company, Liberty Media, speaking to Bloomberg. Manus, we talked about this race yesterday. It certainly has character, is one way to describe it. So I don't know if you saw this, because basically the race was happening when we were up in the silly hours that you wake up and I'm here in Europe. Because it's in Las Vegas, it was basically just happening. We had a practice run, and Manus, they had to stop it because a manhole cover came loose on the racetrack and damaged a car. Now, I'm not an engineer. I don't know a lot of racetracks, but I'd assume you want manhole covers to stay in place. That seems like a basic thing.
Yeah, well, you're just seeing massive gushers there of Las Vegas going up. Can you imagine a manhole projecting on a racetrack? I mean, this is a big moment for Liberty, isn't it? I mean, we were looking at some of the numbers.
Yeah.
I mean, they have sunk, quite literally, a monster amount of money into this. They've put $240 million into buying the land. What is it, 40 acres for the pit, the paddock at the track. I mean, they are knee deep in this to like $500 million in total.
Yeah, I mean, look, they did tell Bloomberg they still think that Vegas is going to draw in the most revenue that they ever have for a Grand Prix. But I kind of can't help but wonder about some of the publicity that's coming out of this. You have the manhole cover thing, and then all over Twitter, you have all these sports reporters posting pictures of empty grandstands. It seems like no one's really showing up as much as they usually do for other Grand Prix.
Well, let's see what the stands look like in the final one. Then, of course, Aston Martin, age-appropriate car for somebody like me, I should say, not on the racetrack, but it looks like they're going to cash in and sell $1 billion stake in the company. It is an age-appropriate car for me.
It's a really good idea. I could definitely see you driving around the streets of New York, not in that car, but definitely in a street legal Aston Martin.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
You're welcome back. It's Bloomberg Brief. I'm Manus Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. President Xi vows to take heartwarming steps to attract foreign companies. Meanwhile, President Biden says much of the world's history in the coming years will be written in Asia. Oil sinks into a bear market. Crude collapses on signs of healthy supplies and rising stockpiles. It offsets Saudi and Russia's efforts to keep declines in check. And the chip war spurs a breakup rethink at Alibaba as Applied Materials faces a U.S. criminal probe for allegedly violating export restrictions to China. Well, the euphoria continues in this equity market. S&P 500 futures up 0.25%. The bots are buying. Goldman Sachs says that CTAs have plowed $70 billion into U.S. stocks over the past 10 days. That is a record. NASDAQ futures, those are a little bit weaker. I mentioned the Applied Materials story. We're going to get more on that shortly. That's also dragging down NASDAQ futures, which is why they're not up as much as the overall market. But this is a market that is hooked on the idea of rate cuts. Geraldine from PIMCO says we're not necessarily going to get a hard landing, but we still could see a correction in equities. We're far from that now, with European stocks, Manus, up more than 1.1%. Again, it is the rate cut narrative that seems to be fueling things. The ECB, traders are pricing in 100 basis points worth of cuts by 2024.
And Danny, that 100 basis points of cuts from the market for the ECB is what's pumping up the bond market. But it almost feels as if, you're running with a bond. The bond bulls are almost like running through the streets of Pamplona. This is 5 days of the U.S. Treasury market. And as you can see, 26 basis points of a drop in yield and a rally in price. And likewise for the bonds this morning, you can see there a drop in yield, 252, 100 basis points priced in to Europe now. When you think about what happens next, PIMCO were very clear. They wrote the same note at the start of the year. Their natural proclivity is to be bullish bonds, but to be bullish the belly of the curve. 10-year paper at the moment comes back 438. It's a very, very clear break to the downside. The view is that you do not get a hard landing. You will not get a hard landing. That is not the thesis from PIMCO on the bullish bond note. When it comes to crude, we just discussed it with Will. We're back in this bear market. A colossal amount of supply. Inventories in the United States of America. Additional supply from Venezuela, from Iran, from non-OPEC countries as well is building into the narrative, down 20%. Will Russia and Saudi Arabia extend the lollipop cut, that's the unilateral cuts, into the first quarter of 2024? Cable at 124.33. Your Christmas present is looking big, large, and very expensive. Good morning from New York. Danny.
Is it an Aston Martin?
No, it is not an Aston Martin. UK retail sales fell in the United Kingdom.
That's too bad.
We will not be getting you an Aston Martin. It's an age-appropriate car for me.
Fair enough.
Me. me. Can we focus on me?
No. Okay.
Thank you.
Yes, I'm sorry. I can't afford your Aston Martin yet. We'll talk about UK retail sales in a bit, Manus, but you were mentioning what we heard from PIMCO, this idea that we don't need a hard landing to see bonds outperform. In the credit market, I think this is fascinating. You brought up the stat from Moody's that they're tracking about 5% default rate in the American credit market. And Geraldine talked about this idea of being very active in the credit market, that you really need to go up, you need to go into high quality, because if stocks aren't going to do well, then of course credit isn't going to do well either. They're very correlated.
And they're underweight duration in Japan. And when we put it to the closing conversation of, look, where do you want to be longest? In bunds, in gilts, in Japan, where they have a lower duration, she prefers the dollar block. That's where she thinks that you are going to get much more bang for your buck.
Manus, let's talk about the lack of shopping for presents for you here in the UK, because UK retail sales fell unexpectedly in October. It paints a bleak picture of the economy. Joining us now, not just wrap up that, but the global week that was in retail, because it was a big week, is Bloomberg opinion columnist Andrea Felstead. Andrea, why was this data so poor?
Well, I think it's a number of factors. The UK consumer has really defied gravity this year, but a few things are probably catching up. We've got the impact of interest rates. There's a little bit of concern that the jobs market's slowing. And there might also be another factor at play. You know, we all spend over the summer on holidays, concert tickets. Those bills all have to be paid. And just around the corner, you've got Christmas. So it's not surprising that shoppers really maybe sort of took a pause in October between those two moments.
Andrea, good to see you this morning. You know, I've been out and about looking for a few suits, doing a little bit of shopping. I've transferred. There are ticket prices write-downs everywhere here that you look on the kind of product that I'm trying to buy. Some TVs, some hard electrical goods, a few new suits. Now, they don't sell suits at Gap, but the quarterly profit there beat. And this is a win for Richard Dickinson. So what's going on there? Have they hit the right product at the right time for the U.S. consumer? Because I think we've had various people come on and say, look, the U.S. consumer will just spend, right up until that last moment. They'll go hard and heavy on the credit card.
I think there's company-specific and broader issues. The Gap is clearly doing some things right after quite a few missteps. But what we've learned this week is that there are clear signs that the US consumer is cracking. Like in the UK, they've defied gravity. We're just seeing little chinks that might not go on forever.
Is this not the worst timing for that, though? We're about to enter the holiday season, which is, you know, the holy grail, the thing that really makes the companies report.
Exactly. And I think we're going to have a real standoff this year, because the companies, one good thing is they've got rid of that mountain of casual clothing and kitchen appliances that they had after shopping shopping habits changed, that they were left with last year. So they haven't got to discount that. But clearly inflation for both food and non-food is coming down thanks to sort of lower freight rates, factory capacity. So prices should be good. But then consumers are really looking for bargains. So we're going to have that kind of standoff. And really, who blinks first shows what sort of Christmas we're going to have.
Well, we're going to get I mean, you never really get bargains in super luxury. I was just looking at this story. Gucci handbags disappointed at the auction. I wonder, is that like the canary in the global luxury handbag mine? But with that in mind, we often talk about aspirational luxury. I suppose maybe that's where a lot of us fit in. You know, the bag, the watch. I don't know whether a $5,000, $6,000 watch is aspirational luxury or not. But are there cracks in aspirational luxury?
Yes, definitely. It has really been weakening. It started to weaken probably about a year ago, 18 months ago.
Yeah.
But it's really weakened this year. And it's not the super wealthy who are pulling back. It's the simply comfortable that maybe spent stimulus checks on a Gucci handbag, or they weren't doing other things like traveling. So they had money to spend on things. And all of those things are reversing. Plus, you've got interest rates, tighter credit. I mean, you've only got to look at the second-hand watch market, which has really fallen from its peaks to show what is happening in that sector.
I'm in the market for a Submariner. I think I prefer that rather than the Gucci.
Not too shabby. Yeah. Are you what? You're going to get an Aston Martin and a Submariner, Manus?
I think
you're
too
full
flashy for me.
You're leaving me in the dust.
No, the truth is, I think it's just a full middle-aged crisis. I think I want an Aston Martin. I've got a couple of watches. I'm grand. It's like, what do you do? Yeah. You know, but driving an Aston Martin in New York is probably a fool's game. We'll get a call now from Aston Martin PR complaining. Andrea, thank you very much. I'm still with the aspirational luxury. That is our Bloomberg opinion columnist, Andrea Felsted, on all things luxury. Let's stick with the earnings now. Alibaba tumbled after reporting results and announcing that it's scrapping the plan to spin off the cloud business because of restrictions on chips in the US. Who better to track the story than Tom McKenzie? He's way above aspirational luxury. He's prime British echelon, upper echelon. Good morning, Mr. McKenzie. Let's talk about Alibaba. What prompted the U-turn?
I'm going to take that and have that branded on a T-shirt, I think, Manus. Look, this is really significant. Like, you nodded to this, right? And this is the first time we've seen really consequential impact on the private sector in China as a result of the US restrictions on chips. Tencent have talked about the pain, but now this is a derailing of this restructuring that had led to actually quite a lot of investor enthusiasm when it was announced, splitting the business into 6 parts. They're walking back from this now, and that's precisely because the cloud business, this $11 billion cloud business, of course, it needs these chips to power that business. Those chips have become harder to find because of the US restrictions that were imposed about this time last year. Really significant policy there coming from the Biden administration. So Alibaba coming out with this big surprise yesterday. You've seen the stock down in Hong Kong today about 10%. They're not going to be spinning off the cloud business. They're not going to be spinning off their grocery business. And they face these challenges. Look, they've come out of this tech crackdown. They've come out of the post-pandemic re-changing of the environment. They're facing increased competition. Some of their senior leaders, the former CEO has stepped down. He was going to head the cloud business. So again, it came as a big surprise. The really consequential part of this is it is linked to those restrictions from the United States. HSBC putting out notes saying they still have a buy rating on this stock, but they don't see any catalysts going forward. In the near term, they say they're going to have to see the consequences of how they restructure that business. That's what investors are going to be looking at in the quarters ahead, even as they say that the valuation looks attractive on some levels.
Well, today's a really good example of how those U.S. restrictions are not just hurting Chinese companies, but American companies, too. We have this report of a U.S. criminal probe with Applied Materials. What exactly is that?
So Applied Materials is the biggest supplier of chip equipment, and the reporting suggests that the Department of Justice is scrutinizing the sale of some of this equipment from Applied Materials into the Chinese market. They have licenses. You have to apply for a license now if you want to supply much of this high-end kit into the Chinese markets as a result of those restrictions towards the end of last year. And the question then seems to be that Department of Justice is scrutinizing whether or not indeed Applied Materials followed the letter of the law, got the licenses they needed to supply this kit. So it is a reminder that this is a two-sided impact to this. And it comes as you look at the big companies in Europe, like ASML over in the Netherlands. We know from our own reporting that their machinery, their lithography machines were used to produce the chip in the Huawei smartphone that caused a lot of eyebrows to be raised. So we'll see, I think, if that scrutiny from the DOJ expands beyond Applied Materials, that would be really consequential. But it again points to the fact that these companies are walking a very fine line.
Yeah, certainly. Tom, thank you very much. Looking forward to seeing your luxury T-shirt when you're next on with us. Tom McKenzie there. Thank you. All right, coming up, we're going to take a look at the week in politics. It's been a big one, from the averted shutdown to Biden's meeting with Xi. We're going to talk about all of it with Terry Haynes of Pangea Policy on Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's your Friday edition of Bloomberg Brief with me, Manus Cranny in New York. Danny Berger is still resident in London. Alphabet CEO discussed the importance of US and China collaboration when it comes to regulation and innovation with Bloomberg in San Francisco. This was yesterday. Take a listen.
It's not going to be easy, but I would start from this premise that AI will proliferate. So this is not the inherent nature of software. AI advances will get out to all countries. And so it is naturally the kind of technology, I don't think there's any unilateral safety to be had. We all have a shared incentive to solve for safety. You could have AI go wrong in one country that will impact every other country. So in some ways, it's like climate change in the planet. We all share a planet. I think that's true for AI. So now that you know that that will be true, I think you have to start building the frameworks globally to make progress. I've seen encouraging progress when the G7 happened in Hiroshima. I think it was a good start. You've seen more progress. The UK AI Summit last week, the administration here, the White House has been leading the way as well. And I saw good, encouraging announcements even yesterday for US and China to start having a dialogue on AI.
Alphabet CEO there, Sundar Pichai, speaking with Bloomberg at the APEC summit. Now, as well as opening a dialogue over AI, the Biden and Xi meeting marked progress in restoring high-level military communications in efforts to combat fentanyl. But how much progress was actually made? Terry Haynes, founder of Pangea Policy, says agreements shouldn't be overstated, calling them, quote, diplomatic bonbons, feel-good sweet ephemera already telegraphed in advance. Terry Haynes, founder of Pangea Policy, joins us now. I love that. Diplomatic bonbons. It's getting me hungry here at almost 11 a.m. Yet to have breakfast, so you can tell why. But Terry, tell me, this was billed as a game changer. Why wasn't it?
Well, fundamentally because they haven't been talking in so long, Danny, and you need to start somewhere. So I'll give them that. But for markets, I think it was, even though not much was expected, it was nonetheless disappointing and brought everybody back to the realistic. Was there anything on trade? No, not at all. Was there any common cause between the United States and China to lower geopolitical risk? Mutual efforts for the Middle East, mutual efforts for Ukraine, et cetera? No, at least not on the surface. Will there be a better China business climate for companies? I think almost certainly not. It's been an unfriendlier climate, not just for United States companies, but even for Chinese companies. And we could all ask Jack Ma about how he's feeling about that this morning. But in a world where you've got the Chinese Communist Party overlaid on every institution, economic and otherwise, it's going to be very hard to make meaningful changes that will last and restore business confidence in China. Finally, on AI, since you ran that clip, I would say, the most important thing that President Biden said in the summit in public was not the D word that we all talked about yesterday, but it was in reference to AI, and he said that he would work with China where our interests coincide, quote unquote. That is the language of a competitor, of course, but anybody that's expecting U.S. and China to make broad common cause on AI just got told that they probably won't.
I mean, Terry, I'm crying in my cups here because there's nothing to take share there at all. I may as well, Larry and Mr. Schwartzman may as well not bother to turn up at dinner. I mean, they got the golden ticket. They got to go to dinner with Xi. Now, I'm amazed because Xi Jinping has eradicated wealth management, disgorged tech, emaciated housing. He's gone to war with Apple. Why would you believe that he's going to have heartwarming steps to attract foreign capital?
Well, I wouldn't, certainly. Do
you think we should take that at face? I mean, I'm being slightly disingenuous, but what I am saying is history since he was last here does not bode well for a heartwarming welcome to foreign capital.
Well, you're being Irish, and I'm Irish American, so that we understand each other. But no, I wouldn't take any of it at face value, and that is no disrespect to President Xi. It's just that the statements for consumption for business community, for the American community, all the rest, are really undercut by China's actions. One of the other things President Xi also said was that, and this is a quote, China will never pursue hegemony or expansion, will never impose its will on others, does not seek spheres of influence, and will not fight a Cold War or a hot war with anyone. Mm-hmm. Well, you can run that with any fact checker around and, you'd get a resounding false. So, the business community shouldn't, and I think probably doesn't, on balance, take heart that there's going to be any major change, negative FDI or not.
Well, President Biden's also Irish American. Maybe deep down he's thinking the same thing, Terry. And you mentioned some of these high-level things they didn't have an agreement on: Ukraine, Iran, Taiwan, North Korea, trade tariffs, rare earth metals. If they didn't do that here, do you abandon hopes that there are agreements on some of these top-level issues?
No, I wouldn't abandon hope, but I would expect that that's going to take a lot of time and a lot of effort. And there's a lot hanging out, not just on the United States side, more obvious to us today with 2024 elections and the like, but also in China. The most important Chinese meetings, Communist Party meetings, the third plenum, has not happened yet. It was supposed to happen before the end of the year. There's been a lot of speculation that it was going to be delayed until after the Xi Jinping-Biden meeting. So there's going to be a lot of heartwarming tests to follow the heartwarming words, and the business community in the United States will see very quickly, I think, whether or not there's anything backing up those words.
Okay, well, actions louder than words. That's the motto, isn't it? Terry, thank you very much. Terry Hens, making sense of a week in global politics. A snapshot of equities for you. We're in the green. Will that endure? Bank of America's Michael Hartnett, Danny, lovely note says, fade this epic stock rally, and a bigger drop in bond yields would trigger a bearish risk event, according to Bank of America. Right now, the money is flowing in to equities.
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Let's get you set up for your trading day this Friday and a look at what's ahead. We're going to get U.S. housing starts and building permits at 8:30 a.m. Eastern Time, plus Fed speak from Collins, Barr, Daly, and Goolsbee. We've also had ECB officials speak, but we're going to hear more from Nagel and Wunsch from the Frankfurt European Banking Congress. And President Biden holds a bilateral meeting with his Mexican counterpart at 1 p.m. Eastern. Manus, I mean, it's already been a crazy week. We've had a lot of data. We had CPI, which really fueled things. We had some weaker home building data, for example, yesterday. We had the weaker jobs data. And it really has ignited this rate cut narrative, which is also igniting bonds and igniting the flows into stocks.
Yeah, but then this goes back to Hartnett's note from Bank of America, where he says, yes, we're down 26 basis points in U.S. Treasuries. The Bund, European markets are now talking about 100 basis points of cuts from the ECB next year. So you're seeing these yields drop this morning. You've got your 10-year gilts. Retail sales are softer there. So the narrative for the bond market is building to be more bullish. There's no doubt about that. But what if we do see a collapse in yields? And this is what Hartnett propositions. A real collapse in yield, a much bigger collapse in yield, would be something that would trigger a bearish risk event. Stephen Major must be sitting happy on a Friday. He must be just sitting back, kicking back and going, ooh, I got that so right at the moment.
You know who else is probably feeling very good right now? UATA, the MOF, Japan. Yeah. I mean, this is exactly what they wanted, isn't it? We talked about the idea that by tweaking some of the yield curve, upper bands, lower bands, whatever you have it, that they were essentially betting that there would be a global bond market rally. They've been given that gift. We're talking about this in the commercial break. Yen now back below 150.
Yes, and that's exactly it. We're down 1% for the day. If you look at the 5 day, the dollar has had a tough old week as well. The question you need to ask yourself there is obviously we're down 1.4% for the week on dollar yen. Well, of course, the Bank of Japan might have been gifted that rally, but we saw the Fed, they've been gifted this bond rally, but that, of course, has implications for FCON.
Yeah, it's very true. Is it too loose? Does it undo the Fed's work? All right, that's it for us on this Friday.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I can't really think of a time when there's been quite this much divergence.
Consumers are pushing back on price, and that's why prices are coming down almost across the board.
High interest costs are finally sinking in. I think we've been impatient with the long and variable lags, but they're coming and they're here.
I would be very, very concerned about a deflation scenario in the U.S. for services.
Is growth going to slow down? Yes, I think so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow, together for the next 2 hours with the wonderful, the brilliant TK Mohammed El-Arian.
It's great to have Mohammed El-Arian here, really, to talk about what's going on in Las Vegas, among other things. We're looking at equities, bonds, currencies, commodities. You know, after what happened to Carlos, Max Verstappen out on the track, practice 2 right now.
I can hear it.
Delayed. They eliminated the fans. The fans can't show up for practice 2. It's almost as big a mess as the shorts call in the market.
Free practice 1, I think Carlos Sainz hit a manhole cover. Is
Something
that right?
like that.
Ripped out the underneath of the car
down.
and they shut the whole race down. Tom, we've been talking about this all year. Sacrificing the integrity of the sport for commercial gain by chasing this market in America.
I think it's a Netflix effect. They got drugged by Netflix and all the success of it, and there's now after Netflix and how they recoup from this. Just to, to get to the serious stuff at hand, John, they're going to do this practice right now, truncated, no one in the stands, ridiculous. Then they open the roads up for Las Vegas commute, and then they have the qualies, which is what I like. This is where they figure out who sits where in the race.
At 3 a.m. in the morning.
It's 3 a.m. our time in the morning.
Wonderful.
It's a big success. Why don't we move on to what Dr. El-Arian cares about?
Mohammed, you have a choice. We can talk about this or we can talk about soft landing hopes and dreams. What's your preference?
So let's talk about soft landing. But before that, there's even bigger Las Vegas news, which I'm surprised Tom hasn't brought up, which is that the Oakland A's are moving to Las Vegas.
Big move. It's, and again, this is the changing of America, John. There's a whole demographic skew here, which Mohammed camped out in Newport Beach years ago. And the basic idea here is the attainment of the South and the West. And you look at the demographic studies, I mean, literally back to the important economic demographics, and the names that keep coming up are Nashville, Austin, Las Vegas, and others.
Can I just say that I don't get it? How you take a sporting franchise out of one city and take it to another one, Mohammed. English football, that is just not a thing. Why do we do that in American sports?
Money.
And that's it, bottom line, right?
That's it, stadiums, money.
Peter Seidler dying of cancer tragically here, the owner of the San Diego Padres. His grandfather is the guy that started it. Walter O'Malley one day packed up Arthur Levitt's Brooklyn Dodgers and moved him out to L.A. And that's when it started years ago.
Let's start this program properly with some price action.
Let's do some price action.
Try and move on just in case people get confused and if you think we've turned into ESPN. Equity futures on the S&P 500 shaping up as follows. We're positive here by 0.2%. Yields a little bit lower. We're down 4 basis points, 439. Mohammed, we've got to sit on crude. The idea that crude has essentially collapsed into a bear market, down more than 20% from the September highs. We've spent this week talking about soft landing hopes and dreams. Do we have to start thinking about an economic downturn in the not too distant future?
Well, some people are talking about this. I mean, to see oil prices down more than 20% from the highs at the time that there's a conflict going on in the Middle East is quite astounding. And that's feeding into the soft landing. And we're going to talk a lot about this, but the market has now fully embraced, not just that the Fed has finished its hiking cycle, which I think is correct, but that we're going to see deeper and deeper cuts next year without a recession. And that's the critical assumption that's now built in across markets.
I want to get the money question out of the way right away. A CEO of a major 2 million employee company in America called Walmart yesterday brought up the D word, deflation, seared into the fabric of Cambridge, Oxford, and the London School of Economics as a study of British deflation of the 30s and 40s. America's never faced that, have they?
They haven't, and we've had Japan recently. And the problem with deflation is it discourages people from buying today. However, I want to stress, the U.S. is deflation in certain products, food being the primary example, and that's why Walmart really cited it. We don't have general deflation, and I doubt we're going to have general deflation.
I mean, I look at the general deflation question, and it is a vector of disinflation in place. Clearly, we see that. What is your optimism of getting back to John Williams' 2.0% or Richard Claridge's 2.x%?
I think Richard is more likely to be right than John. I think we're going to get stuck in the high twos, and the Fed is going to have to make a very difficult decision. Does it live with inflation higher than target because the target itself is too low? Or alternatively, does it acknowledge that 2% is the right target and then crushes the economy? I think that's the choice the Fed is going to have to make.
What's your best guess right now?
I think it's going to go for the former. I think the Fed will understand that pressing 2% inflation in a world where there's insufficient structural supply is not the right thing to do.
So where do you think it leaves this bond market? Let's go through the scores right now. We've got a 2-year at the moment at about 480, a 10-year at about 440. Think about where we've been in the last month or so, Mohammed. We've had a 2-year pushing 525, highs of the cycle, 10-year through 5%, highs of the cycle. How are you thinking about what we come back down to, bearing in mind what we're pricing for rate cuts next year?
I think we've come down too far, to tell you the truth. I understand why some people think that we're going further, but if you look at the inflation dynamics, that's harder to get, unless we go into recession. If we go into recession, then the stock market is mispriced. So you can't have both at the same time.
Has something changed? I think this is what it goes back to. Has something changed post-pandemic that means we don't go back to the pre-pandemic world? That debate, I think, is still ongoing, Mohammed. Where'd you come down on it?
I think the pre-pandemic world was exceptional. It was a world of QE. It was a world of insufficient aggregate demand. And when you have insufficient aggregate demand, you can push into the economy as much liquidity as you want because you won't get inflation. That world is gone. We're in a world now of inflexible supply, and that's a very different world.
Something to talk about over the 2 hours with you, Dr. O'Leary, is growth economics. I've been telling a lot of people to remind themselves of a guy named Solow at MIT in 1956 and the near religious experience of trusting in growth. Can you state that we have a new American growth economics off what some people are indicating is improved productivity, improved efficiency?
So, I listened carefully to our friend Mike Spence, the Nobel Prize winner, because he spent so much of his career studying growth.
Studying with John Hicks. I mean,
correct.
The majesty of that alone.
And he's incredible, and his insights are really valuable. And his bottom line is that most countries have to evolve to a new growth model. The U.S. is the most advanced in that evolution. I think the 3 important pieces of legislation that the administration passed last year were critical in that perspective. So if you look around the world, whether it is the U.S., Europe, or China, all 3 have the challenge of evolving their growth model, and only the U.S. is doing it seriously right now.
Are we too gloomy?
Are we too? No, Lisa isn't here, so we're not too gloomy. Okay. No, I think we recognize that the world is evolving. This is a different global economy. This is a different domestic economy, and policies have to evolve accordingly.
What worries me, and I think the concern of a lot of people listening to this conversation on Going at Home, is you just have to go back 48 hours and we're talking about disinflation, soft landing hopes and dreams. And then 24 hours, 48 hours later, you look to Burberry, a collapse in luxury. You look to Walmart, a warning about the US consumer. You look to crude entering a bear market. And all of a sudden, we're talking about a slowdown and maybe even recession. Mohammed, the bond market's stuck between all of this. We're seeing double-digit moves day after day in either direction. You've written about this extensively in the last few months, about a bond market that's lost its anchors. Is an economic slowdown sufficient to regain some stability in fixed income, in Treasury specifically?
No. I mean, I was really struck yesterday. I was watching you when you said, guess what? We're at the same level of the 10-year as we were a week ago. And my reaction is, how could that be? So I looked it up, and you were right. Now, most people feel that this week is very different from last week because of the inflation print that we've had. We still lack one of the three anchors. You either need an economic anchor, or a policy anchor, or a technical anchor to the bond market. And we've lost all three. So these moves are going to continue. The thing that has really impressed me is that nothing has broken. If you had told me a year ago we're going to see this incredible volatility in the most important market in the world, it's the benchmark for so much else, and yet nothing will break, I would have said that's impossible. So the resilience of the functioning of the market has really impressed me.
The financial system, and of course we had the shock in the United Kingdom off a derivative structure in the pension plans, but to lead to this and measured in standard deviations, which is how fancy people like Alarian think, we had a 6, 7, 8 standard deviation end of the great moderation. There's a hope and prayer we get back to that trend line. That's in years. How many years do you think we heal this great bond debacle?
I think it's going to take time. Remember, we've had 10 exceptional years where the bond market was distorted.
Some would say back to Volcker, we've had, 30 exceptional years.
But the shift to an artificially low interest rate and ample and predictable injections of liquidity fundamentally changed the bond market. And that is going to take time to recover from.
Did you and Bill Gross get a free ride because you were within the great moderation? Oh. Was that such a structural
I'm not sure it felt like a free ride at the time.
No, it didn't feel like a free ride, but did PIMCO, when you built it, you invented it with Bill, was it easier because you had the great moderation?
Just think of investors. Investors care about three things: returns, volatility, and correlations. And we went through a period that because liquidity was being injected into the economy over and over again, we got high returns, we got virtually no volatility, and the correlations broke down, but in your favor. You made money on your risky assets and you made money on your risk-free assets at the same time. That was a great time. We took it to be normal, but it was truly exceptional. And we're going back to a world that I think is more like what we had before the global financial crisis.
It's going to be so hard to shake this, Mohammed, because we've got a whole generation, in fact, a couple of generations conditioned by two major shocks: the financial crisis and the pandemic. And we know how the Fed responds to major shocks. What we've all forgotten is how it responds to just normal economic downturns and upside pressure on inflation. How do we start to get into that all over again?
Yeah, and this is where Fed credibility and better communication is better. John, it's really striking that the market is willing to take on the Fed on a price that the Fed controls. The Fed totally controls the policy rate, and yet the market does not believe what the Fed is telling us. And it is really striking because we have got to restore Fed credibility. Otherwise, we're going to continue with this enormous volatility.
Your thoughts on what's percolating into the end of the year and into Q1 2024. Are there shadows in private equity? Are there shadows in the new non-traditional finance?
Yeah, so one thing that I don't think is priced in enough is that when you move from the banking system to the non-banks, you change the lags in the system. So you see this with commercial real estate. Everybody recognizes that the refinancing of $1 trillion plus of assets is going to be tricky, but because it's over time, we don't worry about it. Everybody recognizes there's a maturity wall in the corporates out there, but because it's over time, we don't worry about it. If it were all within the banking system, we would have worried about it really quickly. So the move from the banks to the non-banks has extended this
And
time.
this is a Michael Spence issue. The regulatory lag here is tangible.
This is that uncomfortable calm, though, as well. Just to borrow that phrase from a long time ago from the Bank of International Settlements, this maturity wall is out there in 2025, and there's just this feeling, Mohammed, that we don't have to think about it. But at some point, we have to start thinking about it, don't we?
Right, but you know what? You enjoy the journey before you get to a destination.
Oh, here we go.
And
you want to give us some good news, bad news? Bramo's not here, please.
No, I totally understand, because momentum is really important, and you want to be exposed to this market. And I think most people have much more of a tactical mindset than they do of a strategic or structural mindset. And investment has become very tactical.
Mohammed, setting the tone for the next 2 hours. It's great to have you with us, by the way. This is going to be great. For the next 2 hours, a fantastic lineup of guests. In just a moment, we'll catch up with Steve Chevron of Federated on the equity market, looking out the next 12 months. Coming up later, tons of Fed speak. Collins, Barr, Daly, Goolsby. TK, what do you expect to learn today going into the weekend?
That they should speak less, I think would be helpful. And, actually, Austin Goolsby, I think, is fascinating here because he comes from the Chicago behavioral social science nexus. And I think he's very attuned to what are the ramifications of policy, much more than others.
Daly said it earlier this week in the Financial Times. It's too early to declare victory.
Love it to death. Everybody's got a different story. Her life story makes her a good Fed president.
Equity futures on the S&P just about positive by 0.2%, trying to get you towards the weekend, towards a third week of gains on the S&P. Yields lower by 4 or 5 basis points. It's a break of 440 on a 10-year. What a turnaround over the last month. Your yield this morning, 438. From New York, good morning.
The world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
We still don't know a lot of things. We don't really know if how tight monetary policy is. We don't know how long it's going to take to get inflation down to 2%. So I think the degree of uncertainty and risk is a lot less today than it was, say, 18 months ago when the Fed started the tightening process. But there's still a lot of uncertainty about how strong the economy can be and whether the Fed is done.
Former New York Fed President Bill Dudley there on the situation in the market. Fixed income, hopes and dreams of a soft landing and disinflation without the pain of higher unemployment. Fed officials and anyone in and around the Federal Reserve basically saying the same thing all week. It is too premature to make that call right now, to make that declaration of victory, Tom, over inflation.
Yeah, the transitory thing is tentative, and there's a lot of other things tentative, and guess what? They're a new kind of data dependent. I can't emphasize enough the ex-post natures. As you know, John, I'm boring you. I'm particularly focused on Japan, Euro Yen 164 to 162, maybe a first good glimmer for UEDA. But the answer is they're all slaves to data dependency. And after this week that we've had, that new attention to data dependency has increased.
If you're waking up early Friday morning, good morning to you. Here are the scores right now. Equity futures on the S&P positive again. 3 days of gains on the S&P 500.
Still haven't jumped in.
Here's another lift, up by 0.2%, potentially a third week of gains going into the weekend. Bonds rally and yields lower by 4 basis points, 4.39. The euro stronger again, 108.71 against the dollar, positive by 0.2%. Crude bouncing back, but this has been the surprise ever since October. You get some tension in the Middle East. We start talking about triple-digit crude back in a bear market on crude, Tom. Just a shocker over the last 6-8 weeks.
To the end of the year, Edward Morse of Citigroup and the Council on Foreign Relations
agreed.
Absolutely nailed it, and it was as lonely a call as Dudley and Ilarion and Anna Wong of Bloomberg Economics a zillion years ago. Maybe I'd throw Hollenhorst in there as well.
Christian Malik, your good friend over at JP Morgan on the energy desk out of London. This is what he had to say in the last 24 hours.
Please.
We could see OPEC Plus do sizable cuts from here. I think it's more likely they'll want to stabilize them among their OPEC peers, a collective cut, rather than one on their own to get ahead of the economic weakness, maybe, going into next year.
And this ties into Jay Pulaski in the next hour, where Malik was looking for EM expansion to boost demand, and it, for whatever reasons, I'm not faulting Malik, but it hasn't happened. So there's the JP Morgan readjustment.
To your point, the bulls have been wrong. Brent crude's back in the 70s, WTI is threatening to break into the 60s.
Right now with us, and to have Mohammed Ilarion with us is a great thrill today. He is at Queen's College in Cambridge, and he's interested in the asset allocation of their endowment. That's the campus of Steve Chivarone, head of multi-asset solutions at Federated Hermes. Steve, this is a lonely bull market. How do you reallocate into the end of the year?
Well, you had to get ahead of it a little bit. We were adding over the course of the summer when it was uncomfortable on the idea that markets like Fed pauses, and they price in soft landings, even if a soft landing doesn't materialize. Because when the Fed pauses, invariably, it's on suspicion they've gone too far, not on confirmation. And so the data that's available to you is a Fed that's no longer hiking and an unemployment rate that's still low. And that's been the case throughout history, and it's the case today. And so finally, with the bond market having broken, we're getting that Fed pause rally, and that can be powerful, Tom. You know, historically, those are 9-month events, and you can see the equity market up 15, 20%. And interestingly enough, and this is something that's been on our mind, the equity market has hit an all-time high each of the last 5 times that the Fed has paused. Now, 4 of those ended in tears, but it still happened either way. And we think this rally has legs. I think the jury on whether or not, you know, how soft this landing is next year is still very much out. But for the time being, we think this rally continues.
Steve, what are you looking at to determine this whole macro question of, has the Fed not just paused, but it's going to start cutting, and can it do so within a soft landing? What are the key variables you look at?
We're calling them the 5 games of chicken, and it's that corporate refinancing wall. You're going to have about 60% of corporate debt come due between 24 and 28. So what percentage of that is going to face materially higher rates, and what does that do to company earnings? That's number one. Number two, for small businesses, they've already seen their debt reprice because it's variable rate bank debt. So how many quarters of high rates can they survive? On the consumer, real income growth has finally turned positive, but how positive does it get, and does it allow a consumer to de-lever again, rebuild savings, and continue to spend? $877 billion of bank deposit outflow. What does that do to restrict lending? And then what percentage of the federal debt, a third of which becomes due this year, reprices to a significantly higher rate? Those 5 things, we think if they were to all go perfectly, you'd get this immaculate soft landing. We think that's unlikely. We think what's more likely is a kind of rocky landing where inflation stays stuck at 3, rates stay high, there's some slowdown, and it's a kind of malaise. It's a single-digit equity environment with a real risk that something breaks and you get into a classic recession. So it's really between that rocky landing and then a kind of a classic recession break that we think is most likely to happen. We're in the rocky landing camp, at least for now.
And what do you say to those who say, of your 5 factors, it's 1 and 5? It's all about supply. It's all about who's going to buy all the supply.
I think that's big, but where I would focus more acutely is on the nexus between banks and small businesses. The banks, again, if there's $877 billion less of deposits, that's $877 billion less of loans that can be made. And small businesses are reliant on that, and they're not facing a maturity wall. They've already seen it. And so if something's going to break, we would look there. So we're spending a lot of time focused there. It also has us biased towards larger cap companies within our asset allocation.
Steve, let's get to the quote that shook up this market in the last 24 hours. TK talked about it at the start of the program. It came from the Walmart CEO. We may be managing through a period of deflation in the months to come. Steve, when you heard those words yesterday, what was your response?
I think the word deflation is probably a little strong, but I do think that there could be a lot more disinflation than what we're expecting. If you look at the areas of the economy where you've seen disinflation so far, it's goods prices, it's food prices, it's energy prices. It's a lot of stuff that, quite frankly, can be explained by COVID normalization. Big interest rate sensitive purchases have not really seen the big deflation that you'd expect, right? I mean, home prices are still relatively buoyant. Go and try to buy a car. It's not exactly a value exercise these days. And so I think as the rate hikes filter through the economy, there is more disinflation in the pipeline. And I think you could see a Fed at some point in 24 go very quickly from worrying primarily about inflation to worrying very much about growth in the employment markets. And that could switch on a dime. And it's something that keeps us in a kind of humble position.
Well, Steve, to that point, is the same true for investors, just to jump in? You mentioned there that the Federal Reserve can make that switch. I just wonder how quickly investors start to make that switch and whether we can get some divergence between what's happening with bonds and what's happening with stocks.
I think what you do is you pull up some charts and you look at them historically. Unemployment takes stairs down and elevators up. The equity market takes stairs up and elevators down, particularly if you are headed towards a recession. You don't gradually shift your view in the late part of a cycle. It happens very, very swiftly. And that's why as an investor, you have to prepare for that. You start to lengthen duration. You start to upgrade the quality of your equities. We like companies right now that have strong balance sheets, strong cash flow generation, low external financing. And you move in that direction so that if it does move on a dime, which historically it does, you're not left out in the cold.
Steve, wonderful to get your thoughts. It's good to catch up. Have a good weekend, mate. Steve Chevron there at Federated Hermes. One of my favourite notes comes out weekly on a Friday morning from Michael Hartnett of Bank of America. He had this to say this morning. Essentially, lower yields are good for risk assets until they're not. It gives you a range of numbers here, Mohammed. 5 to 4% bond yields, bullish risk, easier financial conditions. 4 to 3, different world. He says bearish risk, we'll be talking about recession. Do you think that's the right way to frame things?
I do. I think actually that's a really good way because we all agree on the effects of lower rates and lower oil prices. However, the cause really matters. And if you see rates come down too rapidly, the market is pricing in a major slowdown, and that's not good for risk assets.
A must-read of 2009 had a chapter on a guy named El Arian and a chapter on a guy named Michael Maboussian when he was at Credit Suisse. Michael wrote an essay 20-plus years ago on the concentration of technology, the concentration of return in capitalism. Is that where we are now? That the call, and we're going to come back, John, and talk about this. It's so important. Are we going to just see a continuation of the Magnificent Seven as Maboussian?
I think it's a really important question, Tom. Yeah. Going into next year for the stock market, particularly given the surprise we've had this year.
I think it's key.
They've just dominated in a way that I think was unexpected for many. Equities right now positive 0.2% on the S&P. Simon French of Panmure Gordon coming up next.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Three days of gains on the S&P 500. Let's see if we make it day 4 going into the weekend. Equity futures look like this on the S&P, the Nasdaq, the Russell. The small caps all week, all over the place, up by 1.3% this morning. The S&P up by 0.2. Close positive today. A positive week of gains once again by more than 2% currently through the close on Thursday. Incidentally, 3 weeks of gains on the S&P 500 would be the longest weekly winning streak. TK, going back to the end of July, you mentioned big tech. You want to talk about big tech at the Magnificent Seven? David Costin at Goldman Sachs. This is what he had to say in the Outlook. The massive outperformance of the Magnificent Seven has been a defining feature of the equity market in 2023. Goes on to say, the stocks should collectively outperform the remainder of the index in 24. Tom, this is something you talked about a million times. Faster expected sales growth, higher margins, greater reinvestment ratio, stronger balance sheets than the other 49.3.
I can't believe I'm saying this on November, whatever it is. I don't have a concept for next year. I'm 99% certain it's going to be the probabilistic narrowness of the street and believing the Magnificent Seven will continue to dominate. Many people saying, no, it's going to be this, it's going to be that. And I'm just saying possibly baloney. I'm not there yet.
S&P just about positive.
I'm distracted. You know.
I'm distracted too. Let's turn to the bond market. 2-year, 10-year, 30-year. Looks like this. Just amazing to see the 10-year here. It's not a typo. It's a break of 440 on a 10-year. In the last month, we've been through 5% and now back below 440. Mohammed, 439.46, and we're down 4 basis points. It feels like just a normal snoozy day as a 5 basis point move now. Is that the new normal?
It has been, John. It's been incredible. We've had 10 basis points move up and down. It's been this amazing volatility for the most important market in the global system.
Feels like a penny stock, TK. Some days, 10, 15, 20 basis point moves on very little information. Think about Tuesday. Tiniest downside surprise on CPI. We're talking 10 basis points on a monthly read, Tom, and we're moving 20 basis points across the curve. That's nuts.
We got to stay on schedule here, but 10-year real yield 2.15%, 2 standard deviations moving that, John, is to 2.07. If you have the 10-year inflation-adjusted yield break below 2.07%, what quality of disinflation/deflation does that signal and weaker demand?
Big conversation for us this morning. Let's turn to our top stories. Under surveillance this morning, President Biden signing a stopgap bill to expend government funding into early 2024, avoiding a government shutdown for now. Despite the agreement, both sides remain divided on a number of issues, including Ukraine, Israel aid, and immigration. The measure setting up 2 funding deadlines. Here are the dates: January 19th, February 2nd. Mohammed, the showdown on the horizon, the mother of all arguments over spending.
Yes, absolutely. But the good news, John, is we find a way to kick the ball, okay, and that's fine.
Kicking the can down